Ladies and gentlemen, good afternoon and welcome to the EBA 10th anniversary event. My name is Franca Congiu and I lead the communications team at the EBA. I have been working at the EBA since its very first day, and today it is with great pleasure that I welcome you to this conference, which celebrates a key milestone for our organization. In a few minutes, I will give you a brief overview of the conference. Meanwhile, I would like to thank all of you for being with us today, those who made it to Paris from all over Europe and beyond to listen to what the EBA and its stakeholders have to say, as well as those who are attending our event virtually. As we're getting ready to start, you may want to take your seats. Please refer to the hostesses in the hall for any questions you may have or for any assistance you may need. And for those joining virtually, if you have the swap card platform, you will also be able to seek assistance if needed. Let me also remind you that our event is live streamed on our Twitter account, which is at EBA_news. Commissioner, ladies and gentlemen, the conference is about to start. While those who are just arriving take up the seats and our remote guests dial in, I will give you some information on the event. The chairperson of the EBA, José Manuel Campa, will greet and welcome you before Commissioner Maureen McGuinness joins us virtually to deliver her keynote speech. After the Commissioner's speech, the EBA chairperson, José Manuel Campa, will give his keynote speech. We will then start our first panel, 10 years after, Where Are We?, which will gather the views of some important actors in the banking sector on the key achievements of the authority over the past 10 years. A coffee break will take place at around 4:15 after the first panel. And after the coffee break, we will start the discussion of our second panel, 10 years from now, Where Should We Be?, which will gather the views of some important actors in the banking sector on the future direction and priorities of the EBA. Both panel discussions will be followed by sessions of questions and answers. Of course, we're very keen to ensure interaction with all our participants, both those here in the room as well as those attending our event remotely. All your questions will be handled by our moderators. Those of you in the room can simply raise your hands to ask your questions, while those joining remotely can submit questions via the Slido platform at slido.com, #EBA10years, or simply scanning the QR available on our website, on our social media channels, or on your badge. Our Executive Director, François-Louis Michaud, will close the event with his concluding remarks. While we wait for the start of the conference, you may want to check that your mobile phones are on silent mode. I would also like to remind you that this is a public event, so participants and media representatives joining us today will be able to quote any of our speakers or any other interventions. We just kindly ask you to make reference to the EBA's 10-year anniversary conference. We hope that you will enjoy these few hours with us, and please feel free to contact the EBA staff and hostesses in the hall for any questions you may have or any assistance you may need. All the participants joining virtually can also interact with us at any moment using the swap card platform. And now, let me introduce you to our chairperson, José Manuel Campa, who will take the floor to welcome you.
Thank you, Franca. Thank you very much. Ladies and gentlemen, good afternoon to everybody. It's really a pleasure to have you here and to welcome you to this conference celebrating the 10 years anniversary of the European Banking Authority. This is a special event for us, and we really appreciate the effort that you've made to share with us today. I hope it will be a day full of at least lively debate and an opportunity for those of you that are here in a physical presence to also maybe reacquaint each other and restart with energy some new relationships. Of course, I would like to thank first all the speakers, panel participants, and all the moderators for their willingness to join us today and for their ideas, exactly. I'm sure you'll give us a lot of food for thought. As you probably have noticed in the program, unfortunately, Minister Le Maire has not been able to join us at the last minute because of an otherwise urgent commitment that he had to attend. Nevertheless, we hope that in future occasions we'll have the opportunity to interact with him. I particularly would like to welcome, if I may, the EBA staff that are joining us here in person or virtually. Obviously, day to day, they are the ones that make the EBA the institution that it is today. They are the ones that have made current and previous staff the EBA the institution that it has been for the last 10 years. And it's been a long trip, a difficult trip on day to day, special day for many of us. So thank you very much for joining us and for the work that you do every day. Finally, I'd like to make a special also thanks to those of you that are here and made the effort to join us personally. This is, by now it's become, unfortunately, what looks to be an exceptional situation, but I hope it will become more regular. Also thanks to those of you that are joining us virtually. And we hope that this first experience for the EBA is the first meeting in which we have external engagements with participants since February of 2020. So we're a little bit rusted. And it's the first hybrid meeting that we're holding in our lives, in our history, so I hope it goes well. But if anything doesn't go smooth, I'm sure I'll come with your understanding as well. And now, if I may, let me thank, first of all, Commissioner McGuinness and introduce her for joining us. Thank you very much for your willingness to engage with us today. You've always been very receptive to any request that we have for your presence. I always appreciate very much your willingness to engage with us, but today is really special. It's a 10-year anniversary conference, so thank you again for joining us, and we really look forward to hearing your remarks. Thank you, Commissioner. The floor is yours.
Well, thank you very much for the and how refreshing it is to hear the applause in the background. I'm hoping you're giving me clearly. I have some fallback my side, so please, if there's a problem, let me know. And last comment before I give my remark is around the beautiful flowers, which are the backdrop to the chair and Jose Manuel. I probably should be presenting you with flowers, but I hope my speech reflects our appreciation for the work over the last 10 years of the European Banking Authority, and of course a very happy 10th birthday. And maybe to reflect on Jose Manuel, your comments about thanking everyone at the EBA, and I mean everyone at every level, for their hard work and dedication to the work in hand. Over the past 10 years, you've played a really crucial, central role in implementing the reforms after the global financial crisis. And more recently, you've also helped maintain financial stability during this global health crisis, which, as you say, we're coming out of, but is not fully over yet. And too reliant on short-term funding. Governments and ultimately taxpayers had to bail out financial institutions for the sake of financial stability. And that reality, that harsh reality, needed a strong response. We examined what went wrong, and we set major changes in motion to address the flaws in the system. And I know we have, and I hope we've all learned from that past experience. So with the support of the EBA and the other members of the European System of Financial Supervision, we set out to build a robust and comprehensive framework. We decided collectively that EU-level rules on banking were needed to back up the economic and monetary union. After the establishment of the ESAS in 2011, we adopted the Capital Requirements Regulation in 2013, which ensured greater alignment of rules across the EU. And we set up the single supervisory mechanism a year later in 2014 to ensure that bank supervision was better aligned in the euro area.
We strengthened our capital and liquidity rules so that the EU banking sector could better absorb economic shocks, while ensuring that banks could keep financing economic activity and growth. And the European Union put forward new rules to address the too big to fail dilemma and manage bank failures in an orderly way. So today, our banking regulatory framework is a huge improvement on what we had only a decade ago. We addressed many of the flaws the financial crisis shone a light on. So banks now are much better capitalized. They have enough liquidity and they are not excessively leveraged. And the EBA helped to drive this implementation and is a key player, as you know, in bank regulation. You support authorities in all member states and promote convergence in standards across the EU. But that's not all. You support the EU institutions through calls for advice, preparing technical standards, and by providing practical contributions on your topics of expertise. You helped lay the foundations for a safer and more harmonized framework to address bank failure. Our rules now mitigate the impact on the financial system, the wider economy, public finances, and by extension, European citizens. And your work has contributed to a financial system that has stayed resilient during the COVID crisis. So now let me move to the present. I'm a big believer in finishing what we've started. So completing the process of reform arising from the financial crisis remains a top priority. I think you know that we have a key proposal up for adoption at tomorrow's college meeting, the Capital Requirements Regulation and Directive, which will implement the final Basel III reforms. Our goal is to address the flaws that remain in the EU prudential framework without leading to a significant increase in overall capital requirements. And this should maintain banks' capacity to finance the economic recovery after the pandemic. And the proposal will faithfully implement the standards agreed at international level. And that's something that I had committed to right from taking over in this position here in the Commission. Faithful implementation is important. We're showing that the EU meets international commitments and our banking sector is able to meet international standards. And the EBA will play a key role in implementing parts of the Capital Requirements Regulation and Directive. Under our proposal, the EBA's role as a central data hub would continue to be developed. The EBA will help increase the transparency of the EU internal market for banking, collecting information to address remaining market fragmentation. And while this is already the case for supervisory reporting, we do need more transparency in banks' disclosures. So we will propose that the EBA collects the disclosures by all EU banks and centralizes them on its website, which will benefit market participants. Another part of the work that started but is not yet finished is the banking union. And if we want to support a strong and profitable banking sector after this pandemic, we need to complete the banking union. A full banking union is vital to protect the European banking sector from a future crisis and to safeguard financial stability. We agreed on the need for the banking union after the last financial crisis. Now we need to live up to our political commitments and make the compromises necessary to complete it. Of course, there are still challenges, including reviewing the crisis management framework and establishing a European deposit insurance scheme. But we must have the courage to overcome these obstacles sooner rather than later. We may not agree on everything about the banking union, but we do need a comprehensive plan with political consensus. If we all stick to our positions and national concerns, we will fail to give our full support to the EU banking system that is changing fast. And the benefits of the banking union, combined with the capital markets union, go far beyond financial stability. Together, they can help European banks take advantage of new opportunities in a fast-changing world. And that brings me to perhaps the future of banking regulation, the prospects for the next 10 years of the EBA. The world is digital, or at least going digital, and the world is definitely going green. The financial system over the next 10 years will become very different to the one we see today. And as regulators and supervisors, we need to shape the change that is coming and not be overwhelmed by it. Finance is already going digital. Look at the figures. According to Eurostat, almost 3 out of 5 people in the European Union used internet banking services in 2020. And that is up from just a third a decade ago. So, of course, the pandemic has accelerated the use of digital financial means. Now, the benefits of all of this are enormous. Digitalization can boost innovation, increase efficiency, and drive down costs. Both business and retail customers stand to benefit from having more choice and access to innovative products and services. So digital finance is a top priority for the Commission. And indeed, last September, we presented our digital finance strategy. Our goals are to tackle fragmentation in the digital single market for financial services, to facilitate innovation, to promote data-driven finance, and to address new risks. To make this happen, we will need the support of the EBA. For example, we sent a call for advice to the European supervisory authorities on the impact of new market entrants, in particular technology firms. To manage the changes, financial supervisors need to understand the technologies that banks are using, from artificial intelligence to distributed ledger technology, and look at how they affect their mandate to maintain financial stability. Tech-savvy supervisors are a huge asset in our financial system. They can help fintechs and banks that want to innovate while ensuring that they are properly supervised. The EBA and the European Forum of Innovation Facilitators have a big role to play here, and the Commission will support you wherever we can. Reporting is another area where innovation is affecting supervisors' daily work. Together with the European supervisory authorities, we are developing a strategy on supervisory data to be presented later this year. Our goal is to ensure the use of RegTech and SubTech tools for supervisory reporting by 2024. And this will bring improvements both for supervisors and regulated companies. Artificial intelligence is another very good example of how the Commission, EBA, and other supervisors need to work together in this digital age. In April, the Commission tabled the Artificial Intelligence Act, a proposal to boost the development and uptake of this technology while managing the challenges. We identified one case directly relevant to the financial sector, the assessment of customers' credit worthiness. Banks in the EU are already subject to stringent rules on the use of internal credit rating and granting models. So the proposal outlines targeted exemptions to avoid inconsistencies between the AI proposal and our prudential framework. The EBA will have a key role in making sure supervisory practice across member states will be both consistent and coherent in this respect. Going beyond the Artificial Intelligence Act, we need to give market participants clarity on how new EU rules on artificial intelligence will interact with rules already in place. We want Europe's financial firms to compete and lead in artificial intelligence applications, and this requires clear rules and legal certainty, and we have pledged to deliver this clarity by 2024. Digitalization in finance will keep opening up new opportunities for banks and their customers, but there is a downside. It may also open up new ways for criminals to launder money. And as you know, in July, we proposed a package to address gaps in our anti-money laundering framework. We also share the same priority, stepping up efforts to implement the EU AML framework effectively. And we want an approach here that is consistent and coherent, no matter where you are in the European Union. And in the future, we will have a single AML rulebook, just as we already have in place, for the banking regulation. And that includes extending AML rules to the whole of the crypto sector. And we are setting up a new EU anti-money laundering authority, or AMLA, to help us supervise the rulebook. Subject, of course, to agreement of the European Parliament and the Member States, we expect AMLA to start its activities in 2024, with direct supervision starting in 2026. And the EBA will be instrumental in preparing the ground for AMLA. And for this, I want to thank you for the work you're doing now and indeed the work in the future. Right up to 2024, the Commission expects EBA to make full use of its strengthened powers, including in the field of breach of law. Of course, we are facing another big challenge that will require a fundamental change in our economy and financial system as we look to the next decade. And here I refer to the climate challenge. It is front page news every day across Europe and indeed globally, because climate change is not a future threat. It is already here. Events across Europe, in Belgium, Germany, Greece, tragic events clearly demonstrate that the change is happening. And of course, globally, the changes are having severe effects on those who can ill afford to deal with them. So we've recognized that we need to do a serious amount of work in the next 10 years. Here in Europe, we are working towards a 55% reduction in emissions by 2030 and to be climate neutral by 2050. This sounds far away, but effectively it is tomorrow in terms of the time we have to do our work. And those commitments are not just verbal, they are written into law. So we want the whole of our economy and our financial system to become green. And we're putting in place the policies to reach our ambitious goals. You will know of the EU taxonomy, which is a classification system for sustainable economic activities. And this will help companies to plan their transition with clear parameters and to shift investments to where they are most needed. We can use the taxonomy to develop other sustainable finance tools like the EU Green Bond Standard, which will be available to all bond issuers as a high quality mark of environmental commitment. We have the Corporate Sustainability Reporting Directive to improve the flow of sustainability information in the corporate world to the outside world. Given the scale and urgency of the challenge, the Commission proposed a new sustainable finance strategy in July. Our goal is to support industry as it transitions to sustainability and to make sustainable finance more inclusive. With this strategy, of course, we're not just thinking about Europe, we're thinking globally. At COP26 in Glasgow, just a few days from now, we will showcase the EU's approach to sustainable finance and push for ambitious, coherent global action. The new strategy also focuses on the resilience of the financial sector itself. I know that the EBA shares our ambition to improve the resilience of our banks, and we appreciate the work you're doing on sustainable finance. In particular, I want to note the EBA's initiatives to promote the inclusion of ESG factors and risks in the regulatory and supervisory framework for credit institutions and investment firms. Climate risk is a financial stability risk, and regulators and supervisors need to act to tackle it. I think that is a key message that we all need to absorb fully. Just look at the results of the European Central Bank's climate stress test in September. If we do nothing, we risk knocking 10% of Europe's GDP. We risk a 30% rise in defaults on corporate loans to the most exposed companies. And of course, we risk all of the horrible threats to life and limb and communities if we do not act, because the physical impacts of climate are already visible to us around the world. So the future for our financial system must be green, and we don't have a choice here. So let me conclude my remarks. Over the past 10 years, we learned from the lessons from the last financial crisis, and we acted. We put in place stronger and more effective rules for our banking system. The EBA played a central part in changing the EU banking system for the better. Where we are today looks remarkably different from where we were during the financial crisis. Right now, we are finalizing these reforms. The reforms were put to the test during the pandemic, and overall the sector has remained resilient. But low profitability and a possible deterioration of asset quality remain key risks for banks. And so now we are looking towards the future and the next 10 years. The financial system is changing, and banks too will have to change. Embracing innovation will open up new opportunities for the sector. And it is the responsibility of all of us, regulators, supervisors, and banks, to embrace the transition to climate neutrality. You know we have a lot of work to do. I'm counting on the support of the EBA to help us build a European banking sector that is fit for the future. Thank you.
Thank you, Commissioner. And now, ladies and gentlemen, let me welcome again our chairperson, José Manuel Campa, who will deliver his keynote speech before we start our first panel discussion.
Thank you again, Franca, and thank you to the Commissioner again for her remarks and for her presence with us today. I think she was quite thorough on all the things that we've done and all the things that we have ahead. So one of the risks of going after the commissioner is that it may sound repetitive, because I think I would probably agree with many of the things that she said in some ways. But nevertheless, just because we hear them more often doesn't mean that we get bored. On the contrary, maybe we'll get deeper and deeper into us and we'll be able to implement on that front, you know. As you can imagine, I am very, very honored, you know, to be with you today and to celebrate in my position as chairperson of the European Banking Authority. The creation, as the Commission was saying, of the EBA was part of the EU answer to the challenges of the global financial crisis from over a decade ago. And for those of us that are old enough to remember what that crisis felt like, I think we have not forgotten it. And I think it's early to say that early in the crisis, you know, the high-level group on financial supervision in the EU put forward a set of proposals, you know, as a part of the answer to this crisis from the point of the EU. You know, an answer that has been common, or the proposal in this group, the proposed answer that has been common to many of the solutions that Europe has been put forward to all the crises that we have been confronted over the last 50 years, which basically the answer I can summarize in more Europe, not less, is needed to address this crisis. And in this context, that referred to basically foster supervisory and regulation repair of the EU financial sector by creating more Europe, not less Europe. So the La Rosière report, you know, recommended in essence to establish an integrated European system for financial supervision through supervisory authorities, a European Systemic Risk Board, and the European Banking Authority was born, as you all know by now, I assume. And while we have grown in size, in tasks, we have morphed in some of the things that we need to do, we're probably shifting some of our priorities, I think that the EBA's mission remains the same, you know, which is to serve EU citizens, to ensuring an efficient, transparent, and stable EU financial system, particularly banking sector, in our context. Now, the list of challenges back there in 2011, where the European Banking Authority took up the mission, were, I will almost say, overwhelming, because the core of the crisis, as opposed to today, was on the banking sector. Not just on the financial sector, but to a high degree on the banking sector. By then, the global crisis had eroded to trust on the solvency and liquidity of counterparties, to having panic in some banks, to massive lending and funding from the public sector to support the banking sector. And the subsequent bailouts of banks have also resulted in an increased negative loop between banking risk and sovereign risk that threatened the stability, the macro stability of many EU member countries at the time. At the same time, if I may say, you know, citizens' trust in politics, in supervisory authorities as well, faded away as a result of the hardship of the crisis and the cost of the crisis on taxpayer money. So at the time, I think first and foremost, you know, the EBA task was to restore trust. You know, trust in the status of the banking sector overall, but also in individual banks, so that they can be comfortable and they can trust each other, and they will trust among themselves, so they can start operating with each other, they can start lending and borrowing from each other. Also between banks and financial markets, so that trust could be built by investors and other stakeholders. I would say also trust among supervisors. You know, all of this with the goal to restore the functioning of the financial markets. Now, on my view, and obviously I'm here speaking about strategy that I've seen from the outside, you know, but I have experience now from the inside for a couple of years, you know, that the EBA rallied in two pillars and built its strategy to resolve this trust issue into two pillars: stronger rules on one hand and enhanced transparency on the other. Okay? On the stronger rules, I would say that very much in line with the initial proposal of the La Rosière report, more Europe, not less. You know? So that guiding principle, maximum regulatory harmonization with enhanced quality of supervision, became the new objective. You know, and the EBA embarked on this venture by consolidating the single rule book. The Commission also mentioned the new capital requirements regulation that was put in place in 2013. And since 2011, the EBA has consolidated a consistent set of rules on the banking sector, on prudential and also on resolution aspects, with more than 230 technical standards that have been provisioned. I have here the statistics. I think more than 120 guidelines, and we provide the answer to 2,000 Q&As. I mean, you can judge also quality, but on quantity, you cannot be unsatisfied. In fact, I would say some stakeholders probably think that we've gone a little bit overboard, maybe, you know. But I think that all this has clearly helped the supervisory community to develop common practices, leading to more coordination and also ultimately to more convergence. On the other pillar, to enhance transparency, I think that the EBA stress test and the transparency exercises became crucial elements to ensure better monitoring of risk build-up and increased market discipline in the sector as well. Here again, I think it's fair to recognize that it was a bumpy beginning, you know, but a lot has been accomplished in the 6 stress test exercises that the EBA has performed in these last 10 years, you know. And if we were to compare, you know, the amount of drama that was involved, and I can guess only from the outside, but I was a participant margin on the outside as well, on the first EBA exercise back in 2011 with the smooth sailing ride that we had on the stress test of 2021, I think that's clearly, to me, a manifestation of the progress that has been made, you know. I think predictability, transparency, accountability on the way we do the stress tests and the way we perform them have all enhanced and have all helped to enhance, as I said before, the credibility and the use of the outcome of those stress tests as we go forward. And there's a lot of work that can still be done there, but we should not minimize the work that has been accomplished. Now, beyond the stress test, as I mentioned before, the work to enhance information disclosure through the provision of reliable, comparable bank-level information has made the sector more transparent. I think regular releases of bank data and information are valued as essential to improve overall market transparency. I'm very happy to hear the Commissioner today saying that they expect us to play an even bigger role as we go forward. I think that's important, and I think that's been highly appreciated by stakeholders, and I hope that's the case. Beyond that, it's not just about transparency, sometimes it's also about transparency on things that need to be worked on so that it can be improved. And I think here clearly the work that the EBA did on NPLs, you know, with the introduction of harmonized definition of NPLs and many other work that has clearly had a very concrete impact in the decline of NPLs over the last 5 years. One of the very nice surprises that we have found over the last year is actually the NPL ratio in average of the European Union has been declining. A big decrease of that decline is actually not because the COVID situation we think is better, which is good, much better than we expected, but it's because the continued cleanup of the legacy NPLs in those banks and those countries that still have very high NPL ratios was able to continue in this epoch of market turbulence, and they were able to continue downloading some of those NPL portfolios from their balance sheets. So that's very good progress. Now, this progress obviously was not just the EBA alone. It was part of a broader regulatory enhancement arising from the crisis that was taking place internationally and Europe way beyond the banking sector. I think in these 10 years, the international and the European community, we know we have all increased our standards, have been able to make the system less leveraged, I think also more liquid and better supervised. I think progress in banks has been clear. It's not only about capital and liquidity. We obviously have improved, but also enhancing corporate governance as a buffer against risk-taking, enhancing transparency, and also supervision has also been enhanced, and I think now it's more intrusive, more risk-based, and also more forward-looking, all characteristics that I think are positive in the right direction. In Europe, as we know, after the creation of the EBA, and as the Commission also reminded us, you know, the elements of the banking union have harmonized the level playing field for large institutions in terms of supervision and resolution. That's also important progress. And the creation of the banking union with the single supervisory at the ECB has provided stronger supervision and harmonized supervision. Also, the establishment of the Single Resolution Board has been a strong continuation of this agenda, and we have built in the interim a recovery and resolution regime that has helped shed the public sector, I hope, from bank failures. And banks now are paying for their own safety through an enshrined deposit guarantee fund scheme and also through the Single Resolution Funds. And I also want to take the opportunity to thank Andrea and Elke for their presence here today as chair of both of these institutions. You know, I think despite the integration steps in the euro area, you know, with the banking union, made it even more important to ensure coordination and cooperation across the union, you know, particularly between banking union and non-banking union members so as to preserve the single market. And I think here again, the EBA is clearly a forum for this exchange on supervisory resolution practice across the single market and to enhance that single market continues to be effective across all the European Union. In addition, as you all know, during this decade, the EBA mandate has also been enlarged not just to include the prudential regime for banks, but also prudential regime for investment firms, to include oversight in payments, areas of mandates on consumer protection, also to continue, as the Commissioner just reminded as well, the EU framework or the existing framework for AML in financial institutions. And these are important tasks that we have been performing over the last years. So now we are where we are, and I think the last 18 months have been very disruptive to many of us. As I mentioned in my initial remarks, I'm very happy that we're able to hold this hybrid event today, but this is just a small reminder of what we went through. You know, I think like health and the health crisis, financial stability is a global public good, and we need to continue to preserve that, and that should be our challenge as we go forward, and I'll elaborate on that a bit later on. I think that the regulatory and supervisory repair throughout the last decade has boosted the resilience of the EU banking sector. I think that the experience that we have over the last 18 months of the COVID-19 has proven that this enhanced resilience has helped us better manage the health challenge and the implications that it has in the financial system. That's always positive. We join, as the EBA, in these coordinated relief efforts to prevent a shock with many other institutions, including the European institutions that were built in 2011. I'm thinking particularly the ESAs and the ESRB in the context of the Joint Committee, but I think also with the Supervisory Board and with the SRB in an effective manner, you know, to provide guidance, flexibility. We provide guidance in how to apply the regulatory framework. We obviously publish guidelines on the application of moratoria. We also balance, I think, properly operational and supervisory relief measures. At the same time, we're also asking and requiring, in some cases, prudency from banks in preserving capital. Fortunately, I think, and to a large degree, thanks to these exceptional monetary and fiscal measures that we took, but also to the exceptional monetary and fiscal measures that were taken by other authorities, the COVID crisis has not been so far very severe on the banking sector. And that's something that we should be pleased about. You know, we just published in July the latest EBA stress test exercise, and it confirms the enhanced resilience of the banks. You know, despite what was claimed to be the harshest macroeconomic scenario in a stress situation that the stress test put forward, and also the different qualitative situation of the stress test, which was a lower for longer scenario. The resulting core equity tier 1 ratio for the industry on average was slightly above 10%, which is a quite positive result. However, you know, as a lesson learned from the previous crisis, you know, we must not get complacent. And that would not be fair if I don't highlight that, of course, around that average, there is a distribution. There was a tail of banks that did not meet minimum capital requirements. And also the stress test results also show dispersion, you know, with banks more focused on domestic activities and those more affected by COVID crisis, and also those more reliant on the net interest income being more affected by the outcome of the stress test and more sensitive and more vulnerable. You know, so in this sense, I think we should be cautious in seeing the last 2 years as a test of our regulatory framework and the resilience of our banks. We should be careful also, I think, about drawing conclusions on what part of the regulatory framework has worked or which one hasn't. Because from my perspective, capital and liquidity has remained ample throughout the system. Banks have not used most of their buffers, so we have not really tested the functioning of the we learned something about how the buffers are likely to work. We learned something about stigma. We learned something about potential usability or not usability of these buffers, but we have not really tested them. I also think there has been very limited need to use so far a recovery and resolution framework, and that has not been tested either, and we know that work needs to be there. In addition, we also know that the structural challenges that were affecting the industry prior to COVID have not gone away. I will go even further. I would say that on the contrary, they have accelerated. So those challenges remain, and we were not sure on the job that we had done, had completed the job 2 years ago, which is continue along that route. I think that on a macro level, it's fair to say that the financial system now has become more interconnected as we're exiting the COVID-19, that the government support measures that have created a lot of release in the short term have also created new connections between corporates and governments, and also banks, and that may raise further concerns on the stability of the financial system as we go forward, and we have to be watchful for that. The banking system today is solvent and has stable capital ratios, but those structural challenges remain, and we need to continue to tackle them. Pre-crisis challenges and new challenges that came out of the COVID-19 remain in the EU banking sector, and I think that in the short term, at least, credit risk will continue to be a key concern going forward in this environment of uncertainty that we still have forward. I think that it's likely to think, we've been saying this systematically since the beginning of the crisis, we've been proven wrong in some ways. I'm happy that we've been proven wrong, but I'm happy also to continue to say it. We expect that defaults and insolvencies of non-viable businesses are likely to come forward, are likely to bring forward a number of NPLs into the system that will need to be managed, and that may turn weaker banks into even weaker banks, and there may be further challenges on the profitability of the center. The bank's profitability, as we know, is widely dispersed, and it's often driven by local and business model aspects, but there's still questions about the ability of large parts of our banking system to maintain sustainable business models over the medium and long term. Poor profitability of EU banks, I think, is also reflecting the low market valuations that we see of these banks. This is not a recent trend. I look at some statistics, and since the creation of the euro in December 1998, according to the Morgan Stanley Capital Index, European banks show a negative return performance on shareholders of minus 0.36%. That's not a great performance, and something that we need to make sure that it reflects the past but not the future. The past, and despite the most recent rally in equity markets, and also we compare poorly when we think about American banks, for instance, another benchmark. When I think about the price to book value there, the average for European banks is 0.6 price to book, while for US banks it's more than double that ratio at this stage. So that gives us some areas for concern and then areas for reflection, I think. Furthermore, and I don't want to sound too green, but the main drivers of improved profitability over the last 6 months are substantially increased income from fees and net trading, and also from reduced impairments. Both things which seems to me that appear not to be sustainable for the long term. So we should not count on those drivers to remain to us for a long time. Going forward, I think we need major additional improvements for EU banks in their profitability, and that involves broader thinking in the sustainability of their business models, in the existing market structure, and the need for substantial restructuring of the sector. And I think that's a job that we need to continue to remember that needs to be done. On top of that, if I may, in the last decade, and the Commission again spoke heavily about this, the world around us has also significantly changed. And as a result, the banking sector now is confronted with new opportunities. She highlighted the opportunities and also new risks. She did mention the risks, but I'm going to probably highlight more the risks than the opportunities. The mission of the EBA has adjusted and has evolved to a certain extent, and it will continue to adjust and evolve to address these risks. But let me reflect a little bit of what do you think that we go from here. And I'll start first with, I don't know if it's the easy stuff, but it's the obvious stuff. Finishing what we know needs to be finished. And the first one, just like the Commission, the list here is exactly the same one as the Commission. First one is implementation of Basel III. I'm happy to hear that tomorrow the Commission will put forward a legislative proposal. As you know, the conclusion of the Basel agenda is an essential part. We must preserve the global compromise and uphold trust in Europe side by implementing the commitments that we did or that we engaged in Basel firmly, consistent in a timely and faithful manner. In the same manner, I think we will continue to commit at the EBA, and I think I speak on behalf of all other supervisory regulatory authorities, to collaborate in the global regulatory framework, and make sure that the standards and international fora continue to operate to provide common standards and assure, global financial markets open with a level playing field. The second aspect that needs to be done, also mentioned by the Commission, obviously, is the progress on the banking union. As regulators, I think we all know that our work to foster an integrated single market in banking sector is at least at best, I would say, not just at least at best, incomplete. And the evidence is in front of us, and sometimes it's overwhelming. It is true that the banking union has helped to reduce the cost of funding differentials for banks across the EU, particularly the banking union, and potentially attenuating the link between the sovereign and the banks that I mentioned was one of the crucial challenges that we had 10 years ago. However, it's also true that cross-border banking activity in the EU, which had significantly reduced as a result of the crisis, and not just significantly relative to historical terms, but also significantly relative to comparative terms to other jurisdictions, is now progressing. The share of EU EEA bank exposures to our counterparts in other EU or EEA bank areas has remained stable since 2014. It hovers around 24%. And that's, for me, an important challenge that we need to work. It's paradoxical that we built a large institutional structure to create a banking union, to create integrated supervision, and we're finding ourselves operating with a banking sector that's now more integrated than before that effort. Now, we know that significant difficulties remain in the provision of cross-border banking services. We know what many of the challenges are and also where the difficulties exist. And so we know, but we also know the value of completing banking union, of harmonizing insolvency regimes, of private risk sharing, and other areas for reform. And we will continue to signal for the co-legislators that urgent progress is needed, in some of those areas that require action by the co-legislators. I think we also need to continue to push, as I did earlier in the intervention, for an adequate integration of banks, to ask them to change and restructure as needed, to enhance their business models, their risk management, their sustainability, and their competitiveness. And that's the job the banks should do. But I think we also need to reflect and act on what we can do as regulators and supervisors to help solve the problem. Here it reminded me of a famous quote from Kennedy, when he said, "Don't ask what your country can do for you, ask what you can do for your country." I think that we should try to implement that to ourselves. We need to think what we can do to enhance supervisory convergence, to continue to enhance our trust and cooperation among authorities, to alleviate many of the home host issues that we know remain are present in the regulation, and to facilitate the further development of the single market, and particularly of private risk sharing. This is urgent, and if we not do it, I think we risk to fail in delivering on our ultimate objective, which is a safe single market of banking services to serve EU citizens. Now, let me quickly focus on other parts of the regulatory framework that needs to be developed further, which also would not surprise to you, and they were very clear from the Commissioner's statements. Before, I mentioned the poor return on equity of the EU banking sector over the last 2 decades. That poor return on equity is even more miserable if we contrast it to the behavior in equity markets of technological firms. If I only mention the 5 big tech giants, account now for a combined market share over $5 trillion. Much, much more, of course, than the combined market share of any bank or financial institutions in Europe at this stage. New technology firms, not just big firms, but both of them, are scaling up their businesses. Lines in financial services, big techs worldwide are key operational suppliers to the industry as well, and they have already gained a substantive footprint in payment services, and they're starting to enter in other areas like lending and wealth management services. The technological disruption and transformation of business models brings about new policy challenges for us as well. Some are already known to us, and we're working on them, such as the mitigation of cyber risks, which, for instance, I think is on the top of the risk map of most of our supervisory authorities, or on the oversights of operational resilience, as well as some consumer issues and some crime protection issues like that the Commissioner mentioned. Other risks, I think, are new and relate to the provision of all and new financial services in a context of changing market concentration and also issues related to data governance and privacy concerns that we need to be confronting. Banks will need to invest in digitalization to keep up with these challenges and upgrading their systems and their knowledge. But supervisors will also want to do that, and maybe even more than banks. We need to be able to upgrade our systems, we need to be able to upgrade our technologies, to be able to upgrade our human capital to confront those challenges that are ahead of us. The second one is also obviously mentioned by the Commissioner. There is sustainability. The transformation of economic activity is expected will not take place without financial stability and a well-functioning banking system. The Commissioner mentioned already that climate risk is a financial stability risk. I think, if nothing else for that, we obviously have a key role to play. We need to ensure financial stability. I think I will share with her, and I will share with all of you, the thought that the transition to a sustainable economy will will take much longer and will be much harder if along the way we find ourselves with a crisis of financial stability or another banking crisis. So we need to ensure that adequate measurement and management of risks arising from climate and sustainability-related risks and policies should be the driving force behind all our efforts in managing this transition. We also need to ensure that the industry is ready to channel financing and provide advice to their clients on this transition. Banks can also act, I think, as a catalyst in the transition by requiring customers to enhance the quality of the information and the quality of the risk management of their activities in this front and report to them key parameters that may be useful as well for banks to enhance the risk management. As regulators, as I say, we will need to invest in knowledge, talent, we need to upgrade our internal and external process to address these challenges. At the EBA, we have actively engaged with the industry. We're actually engaging with our colleagues, the supervisory authorities and the competent authorities, and collaborating and helping to upgrade this existing, if I might say, infrastructure, but I think that upgrade is urgent. Now, let me finish with two final thoughts on the implications that these two trends, technology and sustainability, will have for our regulatory environment and the way we'll go about our business. I think the opportunities offered by technology imply that the value chain of financial services is being redesigned, from payments to funding to crypto investment to liquidity holdings. We need to reconcile that product offers are more and more offered in a cross-sectoral and in a more global basis. This environment suggests opportunities, for instance, to enhance the single market, the provision of financial services through new technologies. But this environment clearly suggests to me that the competitive dynamics in the industry should be much bigger going forward and are likely to be much bigger going forward. This means that new competitors will come in, they may prove successful, also some global incumbent banks will prove successful, and those should excel. And less successful banks, which certainly will happen, we should orderly exit. Now, consolidation among incumbents could play a role in this process. Through M&As, banks might be able to eliminate redundancies and enhance their business models. But also consolidation might also take place through restructuring and liquidation of incumbent banks unable to modernize their operating structure. We should not be afraid of those changes. I would say on the contrary, we should be prepared to accept them and even encourage them to the extent that they foster efficiency, financial stability, and better customer service in the future. I think that the industry over the last 10 years has been too reluctant to recognize failure and too reluctant to recognize success as well in the industry. And we need those dynamics to be more active. The second, I think, is that these trends are not specific to banks, as you will imagine, not even to the financial industry. They are global trends, obviously, digitalization, technology, and sustainability, and the effects that they have affect all economic sectors. So the future will likely bring the provision of financial services in new ways across existing sectoral barriers and with new interconnections. This will require that we enhance our ability to assess those risks, both institutional and systemic. Climate risk is the most obvious challenge that we have in front of us, but I think many of the cyber risks and other technology-related risks are likely to come along this way. We need to do this from a more systemic, broader perspective than the pure sectoral implications. It will also require important institutional upgrades in our framework that we're already seeing, like with the AML, new AML authority, or areas of non-financial reporting for sustainability-related issues in which new key players are coming into the regulatory front. Over the medium term, I think cross-sectoral regulation will increase. The institutional architecture will become more complex, I would say even more complex than what we have today, and partly, I think, rightly so, because the interactions in economic activity will also become more complex. But we will need to make sure that this increased complexity does not impede our ability to react quickly and effectively. For existing sectoral regulatory bodies such as the EBA, this will also require further and much deeper coordination with other institutions going forward. Within the context of the financial sector, we're already seeing the need for further coordination among the three ESAs in the context of the Joint Committee as we think about some of these new aspects of sustainability and technology. And the examples are some of the mandates that are coming in the DORA and MiCA legislation, for instance. And as I look at the near future, we need to strengthen this coordination much more to address those challenges. But I feel this is just a small part. I think that coordination will be much needed beyond the ISAs with the other financial institutions, with national competent authorities, and also with non-financial regulators in areas such as cyber risk, crime prevention is already a fact, as I mentioned before, but I said data protection, privacy, competition, and consumer issues. We need to reflect in the way that we operate our governance and our existing mechanisms for collaboration to ensure that that proper and effective regulation can actually take place in a much more complex environment. Ultimately, however, no matter how the sector may look like, we remain at the service of the EU citizens. I think the EBA will continue to ensure transparent, unified, and safe regulation and supervision in the provision of banking services, whichever form that takes, to the benefit of consumers and the economy. So let me conclude quickly. A decade ago, the banking sector and the supervisory landscape looked differently than it is today, less European and less coordinated. Since then, mutual trust as basis for the single market in banking has flourished, and as a result, the sector today looks also more trustworthy and more robust. The EBA has been a key player in that progress achieved. I would like to thank all current and past EBA staff, as I said at the beginning, as I mentioned at the beginning, for making this organization a truly unique place to work and for the work that you do every day. The commitment of the EBA staff and, and the staff from competent authorities has been essential to the common success, and I must tell you, me personally, has been one of the pleasant surprises of joining this organization. As we look forward, the job needs to continue. The trends transforming our society and the financial industry pose new challenges to ensure that proper financial regulation and supervision allows the EU to reap the benefits that the future holds. And that, I think, is a very exciting future to work for. So thank you very much for your attention. Thank you for joining us in this celebration. Thank you for helping us in the work that we do day to day. And I'm looking forward to discussion on the next two panels. Thanks again.
Thank you, Jose Manuel. We are now ready to start our first panel discussion. I would invite the moderator, Martin Arnold from the Financial Times, and our panelists to take their seats on stage, and also to the virtual panelists to dial in. While they take their seats, let me just give you some information on this panel discussion, which is entitled 10 Years After, Where Are We? The panelists will provide an assessment of the financial integration in the EU over the last 10 years in the context of rebuilding the financial regulatory framework globally. The debate will be followed by a questions and answers session. As said before, our moderators will handle your questions. Those of you in the room can simply raise your hands to ask your questions, while those joining remotely can submit questions via the Slido platform at slido.com, hashtag EBA 10 years, or by scanning the QR available on our website, on our social media channels, and on your badges. I will now pass the floor on to the moderator, Martin Arnold, who will introduce the panelists.
Thank you, Franca. So my name is Martin Arnold. I'm the Financial Times Bureau Chief in Frankfurt. I cover the European Central Bank and the Eurozone economy, but I have been writing about Europe's financial system for almost 2 decades now. I had 5 years in Paris and also had a spell, 5 years, almost 5 years, as banking editor in London, writing about the banks. So I know some of these characters fairly well, but I am delighted to be joined by a truly expert panel to discuss the topic that we have in front of us today, which is to look back. My job is to look back up to the current day. The next panel will look forward from that point. And we're going to discuss the financial integration of regulation and supervision in the EU over the past decade. And it's a hybrid panel today. So we have, joining us remotely is Claudia Buch. Hello, Claudia, can you hear us? Excellent. Claudia Buch is the Vice President of the German Central Bank. And then in person we have To my left here, Wim Mijs, who is the Chief Executive of the European Banking Federation. To his left, we have Andrea Enria, who, of course, is the former chairman of the European Banking Authority. It was the first chairman back in 2011 and is now head of supervision at the ECB. And to the far left, Elke König, who is chair of the Single Resolution Board. Let me just say a few introductory remarks, and then we'll get straight into this panel. As Franca mentioned, I've got lots of technology here. So I've got two iPads. One of these is going to show me any questions that you ask, apparently. And you can ask them by going onto Slido. You just point your phone at this thing on your badge, and then you get into Slido, and you can ask your questions that way. And I will try to take questions interactively as we go, so people watching us remotely or in the room can ask questions as we go, because I like to keep the things interactive. So please send your questions in, and they will flash up here, I hope, and I will try and inject them into our conversation. So 10 years ago, the European Banking Authority was created, charged with helping to create a level playing field and equally high levels of protection for depositors, investors, and consumers of banks across the region. And then, in the aftermath of the 2012 sovereign debt crisis, the Eurozone was at the brink of collapse, and EU governments decided to go further by creating a single banking supervisor and a single bank resolution mechanism for any lenders that failed. So these first two legs, the single supervisory mechanism and single resolution fund, have been realized, but one is still missing: the European Deposit Insurance Scheme. That's what's been talked about before, so there's a key pillar missing. And several proposals have been put forward for that, but little progress made. And as we're in Paris, I'm going to cite Banque de France Governor François Villeroy de Galhau, who said only last month, banking union now lacks momentum and remains incomplete. Let us be frank, the project has come to a complete standstill. So, something to ponder there. The EU's new framework has, however, been tested. First came Brexit, which separated the region from its main financial services hub in London, forcing the EBA to move here to Paris. Then the coronavirus pandemic struck, sending the economy into a tailspin, the worst ever post-war recession, and sent regulators rushing to avert it creating another financial crisis. We'll look at how the new framework has handled these. So I'm proposing to divide our session into three parts. First, we're going to look at the achievements, and I think we'll spend a little bit less time on that because we've already had quite a lot about the achievements from the first two speakers. But then we'll look at the challenges, and we'll explore how the framework has come through those challenges I mentioned. And finally, we'll look at the unfinished business, and I hinted at some of that. So let me first start off by asking you, Andrea, go back 10 years to when you were appointed to chair this new institution called the European Banking Authority. Imagine I've just appeared from the future. I'm a vision from the future. And I'm going to explain everything that's happened in my best FT language in European financial regulation since then. So 450 words on the front page of the FT, everything you need to know. What would surprise you the most about the way things have panned out since then?
Well, thank you. Does it work? Yes. Thank you, Martin, and thanks for having me here, by the way. If I go back to March 2011, when I joined the EBA, and you were popping up from the future, I mean, the first question I would have had for you is, what is the reputation of the EBA 10 years from now? I mean, what is the perception of the people in its technical skills, its independence, its transparency, its impact on the function of the single market? And I think that what you would have told me would have cheered me up, honestly, because it was pretty gloomy then. And knowing that after 10 years, the EBA has come on such a good standing, a respected authority, would have indeed cheered me up. And let me go back to the time. I mean, I think Jose Manuel mentioned a bit, no? It was a bumpy start. We were, I think, 35 people here at the EBA, starting up the shop. And I was browsing and I noticed that the ECB dated the first 10 days of April as the moment of 2011, as the moment where the sovereign debt crisis basically started. So you started having the widening of sovereign spreads, and the CDS, the bank CDS spreads correlation with the sovereign spreads increased a lot. So, and we had the stress test to run, which was quite difficult to deal with in this situation, because everybody wanted us to deal with sovereign risk, and sovereign risk was pretty intractable with the current, with the regulation that was in place at the time. And I think that what the EBA did since then was, first of all, again, maybe we got our criticism of that stress test, maybe deserved, maybe less so, but still we went out with transparency, giving to the market all the information they needed to assess themselves the risks. And I think that created a strong franchise for the EBA. Transparency, data dissemination, data quality, rigorous analysis, factual analysis. I mean, that has become an element of great strength for the EBA, I think. On the second point, again, I think there was the challenge, it was mentioned already, of the single rule book. It was a challenge not only in terms of the amount of work to be done. I think that sometimes people loses also sight of the cultural change that this should have brought about. I mean, the tradition was to sometimes, do rules in a way in Europe in a way that enabled a lot of ambiguity, so that each member state could still, continue doing things the way they had done them for a long while, and as an umbrella to maintain diversity. And I think that the challenge of the single rule book has been very successful. Has been won big time. Now we have really precise technical rules which have been issued through a proper due process, good engagement with all the stakeholders, and no capture, independence. So I think that's also, and I think, again, everybody said it, I have to say it as well, this is all down to an outstanding team here, to really very few people with a very high engagement, very high motivation. So I need to pay tribute to that. But I don't want to dodge your question, and I go quickly on that. What surprised me really is, of course, first, that we went, as you say, to centralization of supervision so fast. At the time, I was thinking that probably it would have taken much longer than 10 years, and that would have been an EU-wide process. And having the UK in the fold probably would have been one of the elements also making it slower to some extent, because we know that there was a reluctance on their side of the channel on moving to more European arrangements. And that surprised me, although, let's say, the sovereign debt crisis, of course, created it was clear that you couldn't have a true monetary union without a banking union. And the second was the fact that you would have told me probably that in 10 years I would have been celebrating the 10 years of anniversary of the EBA in Paris and not in London. So the fact that Brexit came, I mean, that would have been also something that I'm still grappling with in terms of the repercussions it has on the way in which we work in the European Union, and the repercussions also for banking and financial markets, of course.
Thank you, Andrea. For Claudia, if you can hear me, a similar question for you from a slightly different angle. What do you think has been the most important achievement in European financial regulation over the past decade?
Yes, thank you. I can hear you well. I regret, I must say, that I can't be with you. It's very nice here in my Frankfurt office, but it's even nicer to be in Paris and with the group. Anyway, so first of all, before I start, I would like to congratulate the EBA and Jose Manuel and his team for really a lot of achievements. Andrea just mentioned how the whole institution was being set up from scratch basically 10 years ago. And I would argue that given where we stood 10 years ago in terms of the effects of the global financial crisis still very visible, and authorities around the globe putting together packages to make sure that financial crisis of that scale wouldn't happen again, and that the likelihood would be much reduced. And also, given where we stood in Europe with a very integrated financial market, but which also showed its fragility because there was a lot of cross-border contagion of shocks. There was a lot of interconnectedness of financial markets, and in fact, the disintegration of cross-border financial flows that we saw after the global financial crisis was actually most severe in Europe. So it showed that clearly, I think others have said that before, that the crisis was not just about the US real estate market, but it was really about also fault lines in the European financial system. So that was basically the global environment, the macro financial environment in which the EBA started. And I would say achievements have been really global in terms of agreeing on a reform package to make financial markets more resilient, to be able to deal with failing systemically important banks, to regulate derivatives markets, to monitor non-bank financial intermediation. So we all know this was the globally agreed reform package. But I would argue that it was particularly important in Europe to implement these reforms because we are so highly integrated, because we have a common currency with, yes, as others have said, a lot of national specificities in financial systems, but that precisely means that we have to make sure that risks and cross-border risks are being monitored and addressed. And I think, again, coming to your question, what has been achieved, I think by and large, these reforms have been successful. So we know a lot from evaluation studies that there have been no major unintended side effects of the reform. So credit continued to be flowing. We had somewhat of a reallocation of market shares away from the weaker towards the stronger banks, but that's actually what was intended. And from all that we know from international evaluation studies, we also see those effects in Europe. So that I would argue to agree on these reforms and to put them into practice, that was a major achievement. Now in Europe, we actually went one step further. In many other regions around the globe, these reforms were put into place and implemented within the given institutional infrastructure. And in Europe, we did much more. We basically, with the banking union, others have mentioned that we gave supervisory power to the ECB. We recognized with the EBA that we also need consistent standards across Europe. And like others have mentioned, there's a lot has happened in terms of data accessibility, transparency, the stress testing, so all the things that have been mentioned. But I think it's really important to bear in mind that this was not just about new reforms, a new way how we regulate the financial sector, but it was really a new institutional infrastructure. And the EBA, I would say, is at the core of it, because it's a EU-wide institution, and it really has done a lot to set new standards. And I understand that the next panel will look at what's to come, but let me just conclude by saying that I think this is really also the infrastructure to be able to deal with the risks that lie down the road. So we all know that climate change, digitalization, demographic change are going to be major challenges to our economies and also to the financial system. But we do have the right infrastructure to deal with these things. We, of course, have to improve the infrastructure wherever needed. But I think these are more smaller points. I think we really have what we need. And going forward, I guess we'll come back to this on the panel. Sharing data, keeping this agenda of being transparent, I think that will be really important also to make sure that we don't overburden the financial services industry with reporting requirements and make the best use of the data that we have. Let me stop here, and I look forward to the discussion.
Thank you, Claudia. Turning to you, Wim, let me ask you, for the bank's point of view, so the other side of the fence, it's not exactly been plain sailing over the past decade for the sector, nor for the regulators. So where do you think the biggest missed opportunity for European financial regulation has been?
Thank you very much for the question. And to be honest, to ask this question after all these beautiful achievements to somebody who is an optimist and a true believer in European cooperation is an interesting one. I'll try to answer the missed opportunity. I had a whole long list of achievements and positive things, but missed opportunity is always good to talk about. I had a wise European law professor who always said, in European law and in international law, don't look forward to where the end is, but look back to how much you've achieved, so how far you've come. And this is the right way to address your question, in my view. It also, by the way, goes for if you want to climb the Mount Everest. I don't know if any of you want to climb the Mount Everest. Look back to how far you've come rather than where you have to go. But if you look at it, and I had the privilege to literally be there from the start when the Lamfalussy report was launched, and that was an attempt to come to realize that the European legislation was slow and to be quicker in view of market changes, we have come a long way. And then indeed through the Larosière report in 2011, the European Banking Authority was started. But you can call yourself an authority all you want, but that doesn't mean you are one. This is something that you have to deserve. Other people have to call you an authority, not yourself. And again, if you look at what was achieved, then we can really say that if you look back, and many of you can go back to the Financial Services Action Plan, that through the crisis of 2008, the sovereign debt crisis of 2012, and now COVID, that thanks to the EBA, who I always call the master of the rule book, literally the whole banking regulation was rewritten. And I mean that in a good way. I think that the convergence that was achieved was great, and I will come to the missed opportunities. Don't worry. But what I also think was a great achievement is the closure of many national discretions. And I am personally, I must say, that's one of the big step forwards, because indeed, as Andrea already described, many of the rules were written in such a way that you could have national discretions, and indeed, the European Banking Authority played a very important role. Now coming back to the missed opportunities, it was easy to go for the low-hanging fruit. Once you had the systemic decision to go for the European Banking Authority, big steps forward were made. But if you allow me, I disagree with the president of the French Central Bank, because I think it is a question of, and this is a French expression, frapper toujours. Once we have done that, now we've reached, of course, the more difficult issues. Now we've reached the limits. That are still in national law. We still have national bankruptcy laws. We still have national fit and proper laws. We still have local capital and liquidity buffers. And of course, that is in the political will if we want to go forward. But in my view, this product has not come to a standstill, and as was described both by José Manuel but also by Commissioner McGuinness, the challenges that are coming on technology and sustainability are so important that we need to move forward. We cannot accept a standstill. Now, if you look at it, I'm a big believer in the single rule book, but the one thing that it has given us, if you talk about missed opportunity, is complexity. And I would like to say horizontal and vertical complexity. And let me conclude by saying that as food for thought. At the time of Lamfalussy, we were talking about the 4 levels, and we were already worried about an avalanche of detail that would come down every level. And that is a natural human behavior, because if you lose your political fight in level 1, you will just continue in more detail. In the first years, this hasn't happened, but if you now look at the rule book and the amount of words and letters in that rule book, that has indeed multiplied. So we need to simplify. For me, that is vertical simplicity, and I think that many people realize this and are working on this, and the banking union, the single supervisor, and EBA can help there. The second is the horizontal complexity, is that we still really need to work on the member states and the amount of discretions that are still there and the complexities that are still there. Because indeed, if you look at Basel, which we need to implement and finalize, there is no doubt that we have to adhere to global agreements, but also that we have to be very careful that we don't have all sorts of national little presents or gold plating going in. So there's great achievements made, but now we need to be ready for the future on one, and we need to constantly think about transparency and complexity.
Thank you, Wim. So, next question is for Elke König. Thanks for being here, Elke. Can I ask you to assess how these reforms that we've been talking about, introduced since the financial crisis, how have they changed European financial services in your view? What's been the biggest impact on the industry?
That's a very big question. Let me try to give you an answer a bit out of the perspective of a resolution authority. I think what we have to see was in 2007 and 2008, we had a probably over-reliance in modeling the world and in being sure if you have very well modeled it, the risk has somehow disappeared. So what we saw in 2007 and 2008 was bluntly then, when the crisis hit, that what we thought was banks' capital was unfortunately not there when you needed it, or if it was still there, it was not, we were not able to really use it without, well, putting more oil into the fire, meaning ending in insolvencies with somehow unprecedented ideas. So we have, at that time, had to nationalize some banks, probably not because anyone was very keen to nationalize banks, but it was seen as the only solution. So since then, what has changed? First and foremost, I think the banks have realized themselves that they had overplayed it, but the more important part was that on an international scale, so Financial Stability Board, as well as European, we realized also that it's not all solved if you think of yourself and your neighbor takes care of himself. So we needed a European response. The ESAs were the one part, and I think the bigger part then, and the biggest part probably with its impact on the industry as a whole, was creating the banking union. And I was just reminded, and I think that Claudia is one of the authors, we are now 10 years after the FSB key attributes, and key attributes on resolution in particular. And it's fair to say that in 2008-10, when we talked about resolution, we probably meant all our nice wishes we put up on New Year's Eve and forgot about them by the latest around the 10th of January. Nowadays, we have not just in Europe, but also in all other major economies, a resolution framework, which means that we try to really make sure that if a bank starts to fail, it's for the shareholders and the bondholders to bear the cost, at least in principle. We have still some deviations. But I think this is one thing which definitely changed. I also agree, and I'm very sad about it, that what we've seen, but it was a reaction to the crisis, and it has not really revamped, that we have seen a bit of renationalization, because if you get into trouble, what do you do first? You cut all the little shops around the globe, you focus on your core business. And I think here I would agree that we need to really focus now to say that Europe means core business for any European bank, and it's not Paris or Frankfurt or Amsterdam or the like. So I think there we have still quite some things to do. What else has changed? Well, slightly, banks are better capitalized, and it's better quality capital. And I think when I heard all the achievements, I can fully underline them, and I would just add, and we have for all the European banks now, at least in principle, a resolution plan, and we are committed to have ensured their resolvability by having built up the needed MREL, by having worked through all the nitty-gritty details of the plan by end 2024, which would then be only 9 years after we started that exercise. So I think we should also sometimes see how fast we are moving, and a marathon can't be done at the time of a sprint. And I would stop here because there's a lot of unfinished work which we should touch on.
Yep, I'm coming to the unfinished business, but that's the third section. So first I want to deal with some of these challenges. And Jose Manuel mentioned earlier with pride, and I think some justification, the fall in the level of non-performing loans in the sector. And I think I've just got some numbers here. The latest figures from the ECB, from the SSM, showed that NPLs were down to 420 billion euros in the second quarter, which is about 60 or at least 60% below where they were 5 years ago, and that's an NPL ratio of 2.3%. So let me come back to you, Andrea, on this. Do you think that that's mission accomplished? Or could, as some of our earlier speakers, including Jose Manuel, said, it's no time for complacency here? Could the pandemic still cause us to go back into troubled times and in terms of credit risk in the banking sector?
Well, first of all, as Jose Manuel already said, we should be very proud of the achievement in terms of supervisory pressure put on the banks to deal with these issues as fast as they can. The work that has been done, also with a lot of work from the EBA, to try to help the build-up of a liquid and efficient secondary market for NPLs, which has helped this process and was not there when we started this journey, which I think is also another important step. And last but not least, and I can say this because it was not really my doing, it was done by the ECB before I joined. I think the ECB put in place also an important supervisory framework that was then encapsulated also in legislation on how to avoid this repeating again in the future. So the fact that you now have a supervisory expectation and for new loans a rule actually, that you expect that when something goes sour, when a loan goes sour, you have a certain timeline in which you have to write it down. So you cannot build up anymore that huge amount of, that pile of non-performing loans. So this keeps going down, and also banks have been able to continue the process, as Jose Manuel said, also during the pandemic. That's all good news. Now, banks now think that basically the worst of the pandemic is behind our back. So if you look at their projections, they project a further reduction in the NPL ratio up to the end of 2022 and in 2023. Now, we have been more cautious on this. I think that we need to understand, and maybe Elke was a bit brutal on that, but I think that I agree with what she said, that when you are dealing with these type of new events, models can be very deceiving in their forecasts. And I think that we need to be cautious, and we have asked banks to be particularly careful in their and prudent in their estimations, but also in their, let's say, provisioning policies, to just make sure that they don't reverse provisions too early and then they regret it. So I think it's important that we now say clearly that there has been positive development. We've seen each macroeconomic projection coming from the ECB from March 2020 depicting a better economic outlook than the previous macroeconomic projection. So we are going towards a better macroeconomic outlook. There has been effectiveness of the public support measures, which have significantly reduced the amount of defaults. But still, we see that some more fast-moving indicators like stage 2, let's say, significant increase in credit risk, or forbearance measures, we see that these are going up a bit again. So we need to be cautious at the moment, I think.
Okay. So similar question to you, Claudia, if I may. Are we out of the woods yet? I mean, how do you see the banking system in Germany, obviously the biggest Eurozone economy, but also more broadly, how do you see the European banking system coming through the pandemic so far? Are we out of the woods, and how has that new regulatory framework performed so far, in your view?
Yeah, thanks, Martin. Similar question, similar answer. So I fully agree with what Andrea just said, but let me explain a bit. So actually what we did is, and that's a very interesting European project in the ESRB, the European Systemic Risk Board, we basically looked at new data. So there was a new recommendation to collect information on fiscal measures related to the pandemic, and then we analyzed how these fiscal measures affected the banking sector. And I must say, thanks a lot to Andrea and to Jose Manuel, because the SSM and the EBA really helped us a lot with the data, bringing different data sets together. And what we saw is that, these fiscal measures were quite important to make sure that the financial sector, the banking sector in particular, continued operating during the pandemic. So that was really the good news. And I would say that it's the combined effect of the fiscal measures. Of course, we also had monetary policy measures, and we had supervisory relief, but it was really the fiscal measures that protected the real economy from the effects of the pandemic, and thereby indirectly also the banking sector. Now, without higher resilience of the banks going into the corona pandemic, this also wouldn't have worked. So we basically needed both. We needed the higher resilience, the stronger resilience, plus the fiscal measures. So far so good. So that was really successful crisis management, I would argue. But now the question is, as you said, what does this mean going forward? And what we see in Germany, I'm sure also in other European countries, but I can speak more about Germany, and because that's where we do analytical work, we see that basically the financial cycle is in full swing. So we had a buildup of vulnerabilities in the banking sector prior to the corona pandemic, and this is basically uninterrupted. And one important effect to bear in mind is that we get somewhat of a decoupling of idiosyncratic credit risk and macro developments, for the reasons that I've just described, because there was the fiscal measures which basically mitigated the effects of the large decline in output on banks' balance sheets. In our case, by the way, the banks didn't really have to use their capital buffers because of this effect. And that, of course, is something we have to monitor going forward, because we certainly can't take this decoupling of credit risk and macro developments for granted going forward. So the question is what's happening in the next recession, and how would the banks deal with that? And that's something we are analyzing very closely right now. We'll, by the way, come up with our financial stability report at the end of November, and there will be more information on this. But I think this general mechanism, and that's exactly what Andrea explained, is also a feature across European countries.
Okay. Let me ask you, Wim, about Brexit, the B word. I mean, it's been a big challenge, and it's not deliberate. I promise you. I'll give you some nice questions in a minute. So Brexit, it's been a real challenge for the industry as well as the regulators. How has the industry come through it, and how have you seen the role that the regulators have played in that?
Thank you very much for that question. No, it's to be honest.
It's still ongoing. Obviously, there are still discussions on a daily basis.
I can be almost personal on this. I find it a great tragedy. I find it a great tragedy and the way to unfold. But it's a choice, so you deal with it. And this is the way that our regulators and supervisors also dealt with it. We all looked. I think that I'm honest. The way I looked at it from the private sector, from banking, and many of the supervisors and regulators looked at the political events unfold. And the way we looked at it is, we saw it happen. We saw the Titanic leave the harbor, happily sailing to New York with Captain Johnson at the helm, so that can only go right. And the question we constantly ask is, where is the cliff edge? Are we seeing all the risks? And I have to say, on the other side, so the supervisor, Bank of England, and the supervisors at British side had exactly the same concern. So going forward, we realized that our main financial sector was leaving the European Union. So for years we were first monitoring closely the political events unfold, and then we very practically asked ourselves, what does it mean? Now, as you know, this was a slow start, or Brexit. the Brexit deal took some time. So many of the banks, all of the big banks, had their crisis plan, their worst scenario planned for March 2019, when it was supposed to happen. Yeah. So after March 2019, I was relatively relaxed because I knew that all the big banks had made the worst scenario planning, and that was vetted by the supervisors and vetted with the regulators. And I must say, what appreciates, and this shows the force of the bank union, but also of our regulators on both sides of the channel, is that the ability, the moment you saw the political decision being made, we literally sat together and worked together. So this is essential. So in my view, due to the failed ignition of Brexit on the UK side, we had a lot of time to prepare. Now looking at this moment, no, it's not good. We are basically damaging our own financial markets. We are damaging our global position. We're damaging the position of our banks, so it's not all good. You can see, if you look at the discussion on central counterparties, who now, of course, function under a temporary equivalence decision, that we have a lot to do, because I can understand that European supervisors feel kind of worried that so many of the euro-denominated transactions are being done outside of the EU. On the other side, you cannot say anything wrong about the quality and stability there. So, in short, I still believe, and as a very personal view, it's a tragedy, but the banks and the supervisors and the regulators have dealt with it, in my view, at the detriment of both our economies. But we need to stay very close and in very close consult. So I can't wait for the committees to work, for instance, on on equivalence and, for instance, on CCP, but on many other business. The problem is, as long as it's so politicized, it's very hard for us to work it through. But the banks have dealt with it as they would have dealt with any crisis, and thanks to the slow ignition, we were able to pull it through. And indeed, I look forward to a nice question next round.
Good, okay. Well, a slightly tougher question for you, Andrea. You mentioned the stress tests. Jose Manuel mentioned them as well. I mean, just to go back, I mean, in 2015, only 3 months after the stress tests gave an almost clean bill of health to Greece's 4 big banks, they then had to be bailed out. And the country was plunged into crisis. I mean, there's been a pattern of stress tests that, you know, we go back to the original ones with Dexia and Bankia being given, you know, more or less clean bills of health before their bailouts. And now, you know, the stress tests no longer have pass or fail at the EBA level. Do you think that the stress tests are they credible? Are they strong enough? What are your thoughts on this? They've been criticized a lot.
I didn't notice that, Martin. You know, I mean, I think we should, first of all, we should stop talking about stress tests giving clean bill of health to anybody. I mean, that's not what stress tests do. Stress tests test the banks against a scenario and trying to check whether they have sufficient capital, liquidity to deal with that specific scenario. Now, all the cases that you mentioned share a peculiar aspect, which was sovereign exposures. I mean, we were still in 2015, let's say we were still in the, and especially with Dexia, when I joined in the 2011 stress test that we ran, that was criticized. I mean, that was the key issue. And we came to the very difficult corner in which, of course, from the point of view of a regulator, you do a stress test and you test the banks against the regulatory yardstick that you have. You cannot apply another set of rules. Yeah, sorry? Okay, sorry. So basically, you need to test the banks against the yardstick you have, which is the treatment of sovereign exposures that you have in the regulation. But of course, all the markets were looking at was the exposures that banks had to via the sovereign bonds that they had in their own portfolios. And I mean, that has been the big challenge that it was very difficult for us to deal with. And I think we dealt with it in the best way we possibly could, which was by, first of all, giving very granular disclosure on these exposures, so that anybody who wanted to do a mark-to-market of these portfolios, they could do it, and they could take their own assessment, make their own assessment on the risks at the banks. And in 2011, we even went further than that, asking the banks to put a capital buffer in front of the exposures by marking to market the sovereign exposure. So we did the best we could, but you cannot use a stress test to solve the issue of sovereign risk. I mean, that was the key challenge for the EBA at the time. And the stress test has a lot of limitations, I think. We discussed openly how to improve the stress test. We had consultations. But I think now is an instrument which has become pretty well understood by the markets. It is, first of all, a wonderful exercise in giving data and information to analysts, investors, and anybody who's interested. It has become a good exercise also for the banks, to basically benchmark, and for supervisors to benchmark banks against each other. And I think that it has become globally a very important supervisory tool to make sure that banks have buffers above the minima that can be also used in times of stress, as we have seen when the pandemic struck. So all in all, my assessment is positive, and I think that several of these criticisms sometimes are a little bit, short-sighted.
Thank you. Well, there'll obviously be an innovative and a new type of stress test in Europe next year on the climate stress test. Although, unfortunately, there won't be any immediate impact on capital requirements as a result, but I guess baby steps on that one. So can I turn to you, Elke, just to ask you? Okay, yeah, absolutely.
No, I mean, on the point on the capital, I mean, that's the clear, the only thing that bankers ask me about, the stress test next year on climate risk, and that's also on the other side, some would like to see the blood spilling. But again, let me say one thing clearly. I mean, the key point for me is data. At the moment, what concerns me the most is the fact that banks are telling us that they don't have the data to measure their exposures to climate risk. Yeah. So for me, the biggest improvement that we can bring about with the stress test, with the climate stress test next year, will be to push banks to get the data that they need to measure a risk which is already there.
And I think a way to do that is perhaps qualitative capital impact. Those banks that drag their feet or say they don't have enough information to model these risks to hit them in the Pillar 2 capital requirements.
COP26 should also help in getting these data from the clients of banks. That was said as well, because what will help with the stress test is that it also forces banks to really look at their clients, but that's so important in COP26 that we really hope that we now get a data economy, if you want, going, where also SMEs and others start recording these data, and they don't know yet what they do. So we count a little bit on governments to give guidance.
Okay, we're straying a little bit into the next panel and the next 10 years, which I was told absolutely not allowed to do, much as I'd love to do it. Let me ask you, we have actually got a question that's pertinent to what we're discussing. That we haven't got the name, it's an anonymous question. But the question is, and I'll ask you to answer this, because Elke König, because since I've moved to Germany 2 years ago, I see the whole debate about completing banking union and the European Deposit Insurance Scheme slightly differently than when I was based in London. So there is a different debate in Germany, let's just say that. So what the lack of support from several states to complete banking union, is that due to a lack of solidarity in the EU, or the fear of some banking sectors are not strong enough?
I don't think it's a simple lack of solidarity. It's a lack it's an idea about what needs to be done first, second, third. And if you want it to go slowly, you say you need to move everything at the same time, which just means it takes a bit longer. No, but talking about where to move, and you're now nicely moving into the idea of the unfinished business, it's pretty clear that we are in between, and now I use something that Commissioner McGuinness said at our conference, I'm in between frustration, which is probably where Laurent de Gallo was when he made his statement, but also determination, or as she said, some doggedness to make things happen. I don't think that anyone totally disagrees with EDIS. We need the third pillar. And I don't think that you might find the one or the other corner in Germany for this, but in basic terms, no one disagrees with the third pillar. The question is risk reduction, and Andrea has just mentioned sovereign risk. Is this something to be addressed at the same time, or can you park it entirely? So it's more a question of timing, where I see the problem a bit more in a frustrating fashion is we have long stated that we have a weird system in the sense that we have a European resolution scheme, but we compare it to 21 plus national insolvency regimes. So if you can create a European resolution regime, I wonder why you can't create a dedicated European insolvency regime for banks. It seems to me that this comment you normally get, this is involving justice ministers, sounds a bit like in Harry Potter, Lord Voldemort is around the corner. So I am just getting the feeling we just need to think it through. So I put a lot of emphasis on the package that the Commission has promised to bring up, but I also understand that they are a bit slow because they want to see first whether they get political support, CMDI. And my major concern there is if within CMDI you can't move forward without deposit insurance to be addressed, but let's make sure that we're not ending with something we easily end at home with. You find a nice transitional solution for a small piece, and I could swear in my own home, if I put something somewhere just for the moment, it might still be there 5 years down the road. So I dearly hope that on the DGS discussion, on a European deposit insurance system, that we move perhaps in steps, but to a final solution and not to a halfway solution, which is incredibly complex and might not do the full trick. So my clear idea is it's worth really pushing forward. CMDI is needed, EDIS is needed, and we should not combine each and everything. But I wouldn't say that in Germany there is basically no support for it. Depends whom you ask.
Yeah, okay. We've got more questions coming in from the floor. Still a lot of anonymous questions. I would plead that you put your name to your question, but they are interesting questions. So this question, perhaps Claudia, Buch, you could answer this one. Could the panelists please comment on the completion or not of Capital Markets Union? So we're very much in unfinished business now. And it strikes me that when you have the Green Deal and the plan for the Green Deal at the EU level, which is such a priority now, that you're going to need massive investment from the private sector to achieve these objectives. And without a thriving capital markets in the EU, that's going to be much harder to achieve. So Capital Markets Union seems even more crucial, and yet progress is very, very slow. What's your view on this, Claudia?
Yeah, you gave part of my answer.
So sorry.
So part of my answer would actually be yes, climate change, addressing climate change, setting the right incentives, and that we all know is a policy decision about CO2 pricing and other policy measures we need. That's a key challenge going forward. And it was also mentioned, I think it was interesting that Andrea mentioned the difficulty of actually assessing climate-related risks on banks' balance sheet. I think also the taxonomy is going to help with that, but obviously we need a lot of data work that needs to be done, a lot of transparency. But when we think about who's going to finance that transition, clearly it can't all come from public sector money. We need to mobilize private sector funds. And that, to me, clearly has a strong equity component. So it's not just fixed income, it's not just bank credit, although that's obviously also important. But we need very deep, very integrated capital markets and markets for equity. And that's why I think we really have to look again into the whole capital markets union agenda. A lot of proposals have been on the table, and I would say that maybe work on this has been a little bit slowed down. Some also think, well, this was all related to the UK being a member of the EU or not. I think it's in the interest of the European countries, all the European countries, that we push this project forward. Two concrete aspects of it, and Elke mentioned one, and that's insolvency legislation. Obviously, I'm not a lawyer, I'm not a legal expert, but what I understand is it's incredibly difficult to harmonize your insolvency regime. So sometimes you hear that being said. I think it's not necessarily needed to harmonize all aspects of it, but to identify the critical aspects that are needed for capital markets to function efficiently across borders. So that would be high on my agenda, insolvency legislation and the harmonization of the critical parts. And the second is data. So data has been mentioned in many different contexts, but here we have to see that information on firms that are not listed, information on small and mid-sized firms is very difficult to obtain in a consistent format across European countries. So we actually made a proposal also together with Banque de France on how we can use the information that we have already from many European statistical reporting initiatives to improve that data infrastructure and with an eye on the financing needs in the real economy we have to finance the transition to a climate neutral economy. I think we really have to push these projects forward to the benefit of all of the firms that invest, the financial services industry, and ultimately also for the European citizen.
Okay, thank you, Claudia. So another question, it actually dovetails perfectly with a question I was going to ask. I have a bit of a preamble to this question. Jose Manuel talked a bit about profitability. I mean, the average annualized return on equity among Eurozone banks was just below 7% in the second quarter. That's up from 0 a year earlier, but it still lags behind US banks, and as you mentioned. But underlining this, I mean, the most spectacular statistic is that if you combine the market capitalization of the 10 biggest banks in the Eurozone, they come nowhere near the $500 billion market cap of one US bank, JP Morgan Chase. So and that is I think, that is a real issue for Europe in terms of competitiveness. And the lack of cross-border consolidation, which is what this question is actually driving at. So, Wim, there's a good question for you, one I presume you'd like. What is holding us back? What's holding banks back from cross-border deals? Get on with it.
Yeah, that is. I've once said to Andrea when he first suggested that banks should merge at a cross-border budget, that it sounds, when your supervisor asks you to consolidate, it feels a little bit like parents who ask to their daughter when they become grandparents. It's a little bit nudging. But to be completely honest, I think that absolutely point clearly taken. Profitability of the European bank sector has been for years a problem. As was said indeed before, is the crisis, the problems that were there before the crisis have not gone away, and may even be enlarged if we look forward. So we need this. But if you look at cross-border consolidation, and if you ask yourself, when you're the CEO of a large European bank, Martin, and you ask yourself, shall I merge? Now, the first question, of course, is cost of capital should be lowered. And there you again get into the capital markets union, the free flow of capital in Europe. So the cost of capital is your main concern. So that's one. Secondly, if you, we still have the capital and liquidity, you really need capital and liquidity waivers from the national member states, because if it's cross-border, you cannot get your capital down, you cannot have the benefits of the banking union if you still run into national, all sorts of national discretions on that side. Thirdly, there is the huge effort to digitalization. And so as any cross-border merger, any big merger, and anybody who has gone through this will tell you, this leads to a period of looking inward for 1 or 2 or sometimes even 3 years. If the bullets are flying around you, so if you're being challenged by big tech, by really as reinventing the value chain of banks, you don't want to be looking inward. And fourthly, what is also important is the social role that banks have. The question that you can ask yourself, if you want to become a digital bank, just rip it down and start again. But we can't, because banks are not only deeply embedded in the economy of the European Union, they're also socially embedded. They are employers of thousands and thousands of people. So if you just, the only way to get your cost of capital down and is of course by firing on a mass scale people. So if you have these 3 challenges, or 4 challenges, first, you're being challenged constantly by big tech, who have much deeper pockets and who also have a regulatory advantage until they come on the same services. Secondly, you cannot get your cost of capital down because you have local capital rules and liquidity rules still. Thirdly, you have the social impact, and then your client impact, consumer protection, but also closing down branches. Nobody ever goes to a branch, but people are very upset if you close them. Just saying. So there you see that is hesitant. But I do agree that this rationalization needs to happen. But we need to look very, very carefully to what's holding us back. And I think that I've given 4 reasons that are making banking boards reluctant.
Okay. Andrea, do you want to... I know this is one of your favorite subjects.
Yeah. That.
Well,
what's holding us back?
I must say, I mean, first of all, as a policymaker, although many of these decisions are not in my direct remit, I must say that I feel a bit of guilt vis-à-vis the banks on this subject, especially the cross-border. I mean, it's clear that, I met a banker sometime a few weeks ago telling me that he bought a bank in another member state 17 years ago, very profitable franchise, and in 17 years he got dividends paid only once. So it's clear that we are indeed in a situation in which you do have a regulatory framework that still traps a lot of capital and liquidity in individual jurisdiction. If you have that, making the math for cross-border deals work is very difficult. I acknowledge that. So I would say 2 things, though. The first one is that the glass is not totally empty. So that if you look at what happened in the last years, 2020 was the year in which we had the largest amount of deals since 2008. 320 billions of deals in mergers in banks. Well, most of them domestic, but to be honest, let's say there is a good reason also. It's clear that now the main objective of cross-border mergers, of mergers, is not really value creation, revenue generation, is more cost cutting, is more cost efficiency. And in that situation, of course, it makes more sense to have a merger which has overlapping of distribution networks and cost-saving opportunities. The second point I would make is that if you look beyond the full-blown mergers between 2 banks, and you look at the acquisitions or exit of individual business lines, then you get a different picture. Banks have been much more active in terms of, acquisitions of asset management business lines, equity trading, custody. They've invested in digital platforms much more. Some have sold, have exited some businesses, for instance, also NPL servicing. Sometimes banks have said, well, this business doesn't bring me a lot of value. They outsourced it and they sold it. So banks, in terms of refocusing the business model, this has been very useful, and it is a positive development in my view. And in many cases, this has been cross-border. So you have had the franchises which have been built with a real European perspective in terms of creating scale, especially in some of these.
Amundi is a good example. Yeah.
Well, I mean, I wouldn't mention individual names, but there have been several cases in which this has happened. So I see that to some extent the pandemic, a silver lining in the pandemic is that banks, which had been for a long time waiting for the Godot of a change in the interest rate environment, have now been more active in biting the bullet and trying to, restructure their business more radically. And you don't see this yet in the data. If you look at the aggregate data, cost-to-income data is stuck there, doesn't move, 65%. I mean, it's very depressing. But there are a lot of these costs which are one-off. So banks are taking one-off costs, to actually build future benefits in terms of profitability. So I'm becoming a little bit more positive on the situation, and that's why I'm more bitter in terms of the inability to, from our side, to provide an environment which is more open to cross-border consolidation, because I think that the math could be there in a few months maybe, and that's why I also propose to banks to maybe consider some tools. For instance, the more reliance on branches. I mean, a point that I know that bankers don't like it, because let's be honest, on branches, sometimes on cross-border consolidation, banks want to have a little bit their cake and eat it, no? So they want to have an establishment in another country, to basically totally pool capital and liquidity, but then if you look at their recovery plans, they want to be able to sell the franchise if something goes wrong. So they want to be able to leave the keys and leave. And this, honestly, I mean, if they want really to have a fully integrated group, well, then they have also to consider the fact that they need to be there in good times and in bad times. And the branches are a clear commitment that this would be the case. And we could be much more supportive of branches, I think, than we were in the past. Because in the past, if you had a branchification of a subsidiary, awful term, sorry for that, but you would have had a switch of the responsibility from the host authority to the home authority, no? So there would be a big change. Now, within the banking union at least, nothing would change. The responsible authority would be the ECB for the subsidiaries as for the branch. The JST, the Joint Supervisory Team, would be exactly the same, involving all the authorities, even if they are branches, because what matters is, of course, the business. So we are in a situation in which we could make the branch model work much better than it used to be the case in the past.
As you said in a recent speech, Andrea, there are some issues around national deposit schemes and some deterrence on that, but not completely insurmountable, perhaps. Elke, König, do you want to come in on this? You were reaching for your microphone. I'd love to hear your thoughts.
I was just thinking we are now dealing with the lovely topic of home and host. And I liked a bit Andrea's comment that sometimes you get the feeling that banks want to have the cake and eat it. And I think there is a bit of truth in this. But let me perhaps go one step back. When we talk about home and host, and you would normally expect we are talking about banking union versus UK and US. But home host is a very internal discussion. It's about the own family. And here we are currently definitely in a situation where whenever you try to push forward a more integrated view, the first argument you get from the host countries, do you remember 27, do you remember 28? And if something goes wrong, my DGS, and with that, my sovereign is at risk. So part of the discussion is going back to complete the banking union with a third pillar. We have solved the problem, at least the way we have solved it now in the BRRD, SRMR, is with a very high pre-positioning of internal MREL eligible liabilities. Is this a solution? Well, it's a costly one, and it's only a solution as long as you stay nicely within the pre-positioned amounts. So I think what we have committed as authority is that we really want to do a deep dive once more into single point of entry, meaning if there's a resolution, it's a resolution at the parent company and subsidiaries stay in going concern to build up this trust. Then you could say you come to exactly the same situation that you would have with branches, because then it's one unit. And I think if we talk about cross-border banking, having one system within the EU, well, then we need to ensure that if something happens, there is upstreaming of losses, downstreaming of capital, and the fear that a subsidiary might get abandoned needs to be mitigated to the utmost. And for me, EDIS is really the one missing part. We can talk now about technicalities, about contractual arrangements and the like, but as long as you have this fear that if deposits are at risk, it's going on the national purse and not in a European context, you always have a kind of an escape.
Okay, just hold on to the microphone for a second, Elke. I'm going to put you on the spot a little bit on resolution, because so far only one bank has been put into resolution by the SRB, Banco Popular in Spain. I was banking editor at the time I wrote about it. It was controversial. It was an arranged marriage with Banco Santander for only €1. And there's a question why other failed banks, several of them in one particular member state, have not been put into resolution. And I mean, to name an example, what about Monte dei Paschi di Siena, the world's oldest bank that's consistently fallen short in EU stress tests and continues to struggle to find a buyer? Is that not an example of a bank that could be a candidate for resolution?
Well, first and foremost, like Andrea, I'm never commenting on any bank, but let me also make some comments on Banco Popular Español. You said it's an arranged marriage. I would strongly disagree, and really strongly disagree. It was, I think, an ideal, and we were to some extent obviously also lucky, case of a resolution. The bank had put up itself for sale and have tried to find a buyer, but at the same time could not agree on its own board, could not, for whatever. So when the bank failed and was clearly failing or likely to fail, it was for us to take over and to use the tools we have within the BRRD. And the one tool there is to try to find a buyer. And it was a very transparent process, ending, and I think this is what you need to clearly always state, ending with the failure of the fourth or fifth largest Spanish bank. And if you now look back, and I wouldn't tell you the months within the year 2017, you would not find any spike in either government bonds or any of the bank bonds to say this must have been the day. So we preserved financial stability, and the ones that lost out, and I feel sorry for everyone who loses out, but insolvencies are somehow not a profitable game, were shareholders and subordinated bondholders. Taxpayers were spared, bondholders were spared, depositors were spared, and could do their business uninterrupted. So I think a strong, probably even an ideal case of resolution, and I know that my former colleague is in the room. I think we are both proud of what we have achieved there. So, but to be fair, of course, there were other banks that were failing, some of them very clear cases of national insolvency procedures, where you could then see that one problem is that failing or likely to fail is not a terminology in national insolvency laws. So we had some cases where it was very difficult to ensure that the failing bank was then really put into insolvency. In these cases, another plea for harmonizing the system, and I think here we've gone a long way now. And then there are some banks that find a solution, find someone who puts in additional money, finds private solutions around it. Is this always what you or I would believe is in the best interest of everyone putting the money in? Well, but at the same time, you can't forbid anyone to put money into a business if he or she believes to make a margin that you and I might not be seeing there. But clearly, one argument also is, and I've made that publicly, we have, for the moment still, kind of a duality of systems. We have, on the one hand, clearly the resolution regime, where we are, and the good cooperation between supervisor and resolution authority. And we have, on the other hand, what's called banking communication, an agreement, a system that the ECB, that the European Commission had put in place long ahead of the resolution framework, which is not entirely aligned, which has some different options still. This is clearly not an ideal system because it allows a bit that you find an exit ahead of the toll booth.
Okay, thank you very much. I have promised to leave some time for questions from the room. So if anybody wants to raise their hand, we've got about 5-10 minutes left. Yeah. Okay, great. I've got loads more questions to ask, but I don't want to hog this fantastic opportunity to ask questions to this fantastic panel. So anybody, there are microphones, I think, in the room. If anybody wants to raise their hand at any point in the next 10-15 minutes, please do. But it looks like most of you have posted loads of questions on here. So I will ask some more of these. Yeah, so this is a good one. So Monica Kalu asks, how does the EBA see the future of consumer protection with the development of fintech and the multi-sectoral involvement in offering financial services to consumers? So the rise of fintech, I guess that's probably one for you, Andrea, is that? You know, I mean, it's sort of straying.
Well, I'm now a prudential supervisor, so I will be striving in territories which are not mine. But let's say, in terms of, I would take this angle. I don't know whether the person putting the question would be satisfied, but let's say, at the moment, what I'm facing the most is the complaints from the banking industry saying we are at a competitive disadvantage. We are faced with a lot of burden in terms of regulation, tight supervision, and we are competing in the markets with these fintech companies that are, you know, basically under a much lighter regulatory framework, if any regulatory framework at all. And the way in which I'm still thinking on this issue, but the way in which I tend to approach the topic is that, first of all, of course, the bulk of the regulations which are on banks are linked to the specific systemic concerns that a bank failure raises compared to any other entity. So if you have somebody providing payment services, no, if a payment institution fails, I mean, okay, you are a customer, you will initiate your payment relying on another provider. If a bank fails and you have your deposit at the banks, of course, it's a different type of concern that you have. But it is true, and I come to the consumer protection question here, that there are a number of profiles in which actually these entities are probably still too lightly regulated. And I think that, for instance, in the area of anti-money laundering, know your customer, all that stuff, I don't see why, let's say, the banks should be asked to do very, detailed checks while a cyber asset provider should...
if it walks like a bank and quacks like a bank, it should be, regulated like a bank.
Take others people's money, which is, to quote a famous book of the 30s, well, I think that they should also be subject to very tight controls on the information they give to the consumers, on the controls on how that criminal money is not entering the system. And I think that in all these areas, we should probably tighten the bolts somewhat. Another area which I think is also important, which is not very related to the question, but still, let me say it, is operational resilience. You have a number of, for instance, big techs that are now developing business, providing services in outsourcing from banks. And of course, if they have an operational mishap, I mean, the impact on the financial sector could be massive. No? So why should I ask, let's say, a regulated bank to have very detailed and deep checks on operational risk, on operational resilience, on cyber risk, go on site, do inspections, and then have no type of control whatsoever on this type of big beasts that could actually put the whole system in jeopardy. So I think in these areas, I think that the banks have a point on consumer protection, operational resilience. On the prudential aspects, strictly speaking, I don't think that their argument is so strong in terms of level playing field.
Okay, so it's more in operational resilience and AML rather than prudential and capital requirements. Okay, yeah. Claudia Buch, let me ask you a question, which is basically on Basel, and we will get tomorrow. We'll get the announcement, as Commissioner McGuinness said. We'll get the announcement of the EU proposals for implementing the Basel Accord. The Financial Times has seen a draft of these proposals. And we wrote about it at the weekend. And in that draft, it says that there will be a delay of, I think, until 2029 before there is some kind of EBA regulation on, this is on unrated corporates. And I think the reason I'm asking you this, Claudia, is because I think it was particularly important to Germany, where there's this huge Mittelstand, which is, and I think the German government pushed for this, to which the danger was that there was going to be a big jump in capital requirements for loans to unrated corporates. So there looks like there's been a carve-out for those. Is that something that you would welcome if that were to make it to the final proposals, which we obviously don't know until tomorrow?
Yeah, so I can't comment like others. They can't comment on the individual banks. I can't comment on a proposal that hasn't been published. So I don't know what version you've seen.
I welcome it.
Yeah.
Okay.
Yeah.
So I think in terms of substance, one of the issues is, of course, that, and that's a bit related also to the discussion on Capital Markets Union, that we have a different financial infrastructure in Germany, a different structure of the corporate sector, and we just have fewer ratings for corporates. That has to do with a strong share of bank finance. It has to do with this particular legal structure of those corporates. So I wouldn't necessarily say that there's a kind of a structural disadvantage of the German corporates, and some of them may voluntarily decide not to close some type of information, and that's entirely their business decision. So I think in that sense, it's important that, of course, in case there should be frictions on that particular market, the market for ratings, we should make sure that there's no legal, no regulatory constraints. But other than that, I don't think it's that important to grant specific favors. But again, I can't comment on that specific aspect because I haven't seen the full proposal, but just the point I want to make is that the market is different in Germany than in other countries, and we should try and understand the reasons and the effects. And the market for ratings obviously has an impact on access to bank lending, but it also has an impact on access to equity finance, and we should take a balanced view at those two aspects.
Yeah, yeah. Could I ask you as well, Claudia, just while you've got the microphone, this question about branches and home and host supervisors. I mean, I think Germany takes a tougher line to third country branches in terms of liquidity and capital requirements than other countries do. And there have been some cases in the past, certainly, where Germany's actually been quite tough on banks, preventing them moving capital out of Germany to their parent entities. I mean, what do you think about this idea that banks should be allowed to branch all across the EU as a way to try and improve cross-border consolidation and pan-European? It's Andrea's idea.
Yes. So 2 points up front. So first of all, I think that Elke is in a better position to really compare the positions of Germany to other countries. The second point that I would like to make, and there's also a more general point, it's related to some of the discussion that we already had, is that some of the effects that we've seen in relation to resolution, and here I'm talking about resolution and the implementation of the new framework more generally, are of course issues that we've seen during the transition. So as we all said, we basically started a new system from scratch about 10 years ago, starting with the FSB key attributes. Now we see the system in operation. Of course, we still have a lot of legacies or kind of path dependencies in the system, where it just takes time for the system to fully operate. So I think some of the things that we're seeing related to resolution, which in a somewhat broader sense also signal that there's not full trust between home and host authorities, I think are also related to the transition process. So in other words, we shouldn't judge the system by what we've seen, not only by what we've seen in the past 10 years, but how it's supposed to operate going forward. In terms of the branchification, I think Andrea made a lot of very good points here. And I think in substance, it's also a business decision that has to be taken by the individual bank. So how branches versus subsidiaries are treated by the resolution regime and the regulatory requirements, of course, is one aspect. But of course, I think the ESRB did some work on branchification, which brought out that there's many other operational aspects that are also important. So I wouldn't want to pass a judgment on particular strategies, but of course we have to make sure as supervisors, regulators, that there's nothing built into the system which creates frictions to choose one or the other business model.
Okay, that's great. Well, I think we are pretty much out of time, so it just remains for me to say thank you to Elke, to Claudia, to Wim, and to Andrea for such a fantastic discussion. I really enjoyed myself, and I hope you did too. And please put your hands together to say thank you.
We're now going to take a short break. Those in the room can join us for a coffee in the lounge area just outside this room. And for those joining remotely, I invite you to interact with us through our swap card platform. We will see you back at 4:45 to start the second panel. Thank you. Ladies and gentlemen, we're now ready to move on to the second panel. I would invite the moderator, Hannah Brenton from Politico, and our panelists to take their seat on stage or to dial in for those joining remotely. While the moderator and the panelists take their seat, and those dialing in join us virtually, let me give you some information on the second panel discussion, which is entitled 10 Years After, Where Should We Be? The panelists will look at the upcoming challenges for financial services to adapt to a changing and demanding environment while offering solutions and support to EU citizens. The debate will be followed by a questions and answer session, and our moderator will handle your questions. Those of you in the room can raise your hands to ask your questions, while those joining remotely can submit questions via our Slido platform, slido.com, #EBA 10 years. I will now pass the floor on to the moderator, Hannah Brenton, who will introduce the panelists.
Thank you very much, Franca, and welcome to everyone in the audience online and in the room. My name is Hannah Brenton. I'm a financial services reporter at Politico in Brussels. So the last panel looked back over the last decade and the first 10 years of the EBA. But this panel, it's time to look forward for the next 10 years and the challenges ahead. As Commissioner McGuinness said earlier, in 10 years' time, the financial sector will be very different, and supervisors and regulators need to shape that change and not be overwhelmed. So in this panel, we'll get into some of those issues. We'll be talking about technological change and the fight against climate change, as well as anything else that might lie ahead. So please do ask your questions throughout the panel on Slido, and we'll take some time for a Q&A at the end. So without further ado, let me introduce the panelists who'll be offering their really expert thoughts on the topics. We have John Berrigan, Director General of the European Commission's Financial Services Department, DG FISMA, joining us online. Augustin Carstens, General Manager of the Bank for International Settlements, also joining us online. Irene Tenagli, Member of the European Parliament and Chair of the Committee on Economic and Monetary Affairs, also online. And in person, Monique Goyens, Director General of Buch, the European Consumer Organisation. So, to get us started, before we really delve into the details of what might be coming up, if I could ask every panelist very briefly in a few words to answer, what are the real challenges facing the banking sector over the next decade? What are your kind of top themes that you're looking out for? Perhaps if I could start with you, Sean.
What am I looking out for? Well, firstly, I'm looking to tomorrow put in place the last piece of the old agenda, which is the old solvency liquidity focused agenda. We hope to adopt in the Commission the last part of the Basel reform tomorrow. So that's a little bit looking back, I think. I think focus will now gradually shift to more structural challenges in the sector. And there are some established challenges, which I will not go into detail. We've discussed them many times before, related to excess capacity and inefficient cost structures, etc. I think added to those, however, will be some new challenges, and you mentioned them already in your introduction. That's the digitalization of the economy, which has been driven forward actually by the pandemic. So that challenge, in fact, has become, it was always coming, but it has now come forward much more, I think, speedily than we expected. And that's all about finding the balance between fostering innovation in the system, but also maintaining a level playing field. So that's the issue around the banking sector in digitalization. The second big challenge, I think, is climate, which again you also mentioned, where banks will have to both manage the risks to them from the climate, but also to navigate the transition to the carbon neutrality targets. So both the inside out and the outside in risks will be relevant for the banks. And I will just finish by saying that context is all important here. And the context in which the banks will have to address these challenges will be either with or without a completed banking union, and will be either with or without big progress in capital markets union. And I'd simply state the obvious, that if we don't have the completed banking union, and we don't make a lot of progress in CMU, all of these challenges for the banking sector will be a lot more difficult to address.
Okay. Augustin, do you agree with those challenges coming from maybe a more global perspective?
Yes, definitely. I pretty much agree with what John just said. I think they are very comprehensive, very clear. Let me just, for emphasis, dwell a little bit deeper in some of the issues. I think at least there are two key transitions that are going to be important. One has to do with the transition towards a more normal macroeconomic environment. We are coming, I mean, we still are not completely out of the woods with COVID-19. Many of the support programs that were implemented last year are still there. That certainly has supported the financial capacity of different agents and firms. It's still an open question what will happen when those support measures are brought down. Are there going to be more failures or more bankruptcies among firms? And another important issue will be the transition toward probably a more normal or higher level of interest rates. That by itself would probably be good because that would support the margins of the banks. But certainly it might have some repercussions on highly indebted parties. Some of them are governments. So far, what we have done in banking regulation to assure the strength of the resiliency of the banking system has worked quite well. And well, of course, I am all for what John said at the outset, just to bring to a closure Basel III, and well, in particular for Europe to move into the banking and capital markets union. But then there is also the transition on the embracement of all the different issues surrounding climate change. That will represent an important challenge for the banks. It will also represent an important challenge for us as authorities, because we still need to do a tremendous amount of work to have an adequate framework to address these issues as we move forward. And probably the most substantial, more substantial type of challenge will come from the technology side. There, I think the key challenge for the banking system is to be able to confront a tremendous dynamism, creativity, you know, a very fast-moving environment with the situation where sometimes banks are slow to move. They're still subject to important legacy issues. Their systems are not that flexible. So of course, I think that will be a major issue as we move forward. There is a lot to say, but I'm sure that we will have time to comment more on this as we move along in this panel. Thank you very much.
Indeed, I think we'll get into a lot more detail. Irene, if I can ask you, in terms of legislative priorities in the European Parliament, does that tally structural, COVID, tech, and green?
Well, we have several, packages and dossiers on our desk. We will have them soon, as John mentioned, and so definitely that will be probably the main challenge in the coming months. But I would like to add one element to what I believe it will be the main challenge You know, in the past year or so, during which we've been talking a lot about regulation, about Basel III and the review, and of course, I have listened to what the operators and the banks and the industry have been telling and complaining and about a big problem of our industry in Europe, which is profitability. And I believe that we will need to address this issue because, of course, when they complain, they point to regulation, but I don't think that's just about regulation. I mean, I think that this is something deeper that we need to think about. And we need to find ways to address this this challenge that we will have ahead. Regulation can't be the way. Lowering regulation can't be the way to increase profitability in a sustainable way. So, but profitability is an issue. And we will need to think about it. And the first thing that comes up to my mind is, of course, something that we have been debating in Parliament for a very long time, not only in Parliament and the Commission, and which is completing the banking union. I think this we cannot, hide from this urgency. This is an incomplete project, and we see the effects. In our industry, we need to complete it. If we look at, the market shares of the top American banks compared to the EU banks, so we see they are increasing their competitiveness, and we don't have enough of a size of a market that is capable for our banks to be competitive, to do the investments that are needed, also in terms of digitalization. These are very heavy investments. They are fixed cost. Of course, if we could have a real European market that could allow them to spread out this cost and to leverage the scale, it would make a difference, I believe. So we still are far from having the kind of unified single market. Cross-border operations are still subject to a lot of obstacles. We don't see many of them. But just think about the number of M&As that we have seen at cross-border in the EU. I think since 2014 there are less than 10. While domestically are like 180. So I think we have a lot to do on this side and to increase the profitability, to strengthen our industry, to diminish the fragmentation. And this also is related to how we are going to handle the digitalization challenge that has been mentioned in the previous speeches. And this will be the other important regulatory challenge that we are facing already in Parliament, because we are dealing with some of these measures. So we have the market in crypto assets, the digital operation, the DORA regulation. So we are starting to deal with that. We need a strong regulation that allows us to have innovation, to spur innovation, but maintaining the integrity of the market, avoiding fragmentation, and making sure that this becomes an instrument to make our banking industry stronger, more innovative, and more profitable.
Okay, thank you very much. And Monique, do you share those priorities, a stronger banking union, digitalization?
First of all, happy anniversary to EBA. I saw you being born, and I really would like to say that the consumer perspective has been more and more integrated in your work, and I can only be happy with that. This being said, I'm also very happy to have been invited here. I might be a little bit using other words than stability. Banking union, we are in favor of a banking union, huh? That's for sure. But I wanted to turn a little bit the telescope around, and that is a quote that I take from John Hill, which was Commissioner John Hill, who was one of the first, but not the last Brexit victim. But he said that at the moment. And I would like to come back to what Andrea said in the last session of the first panel on the competitive environment. Yes, and I agree. Banks have really dared to to resist competition from fintech. And it is true that there is no level playing field when it comes to regulation, and we would certainly also be in favor of regulating the fintechs at the same level of consumer protection than the banks. I have to say, consumers are not aware that they are not protected in the same way. That's an aspect that really needs also to be highlighted, because they think that they are safe. And that's the case in many, many cases, not only in the banking area. But what I also would like, so we are in favor, and we would really stand behind that, but I would like to put a little bit of a provocation here. It's late, I can do
Great.
that. Yeah, great. Because I also believe that the banks need to change a little bit their customer culture. And they are going to be really in trouble, because the fintech, they have understood how to keep their customers happy. And it's always good to maybe just share a little personal story. And if you have the same experience, put it on the Slido. Because the more I talk about my personal experience, the more people tell me, oh yes, I had it also. So I needed to go into a branch, Wim. And it took me 4 weeks. In fact, during COVID, every shop was locked down. Banks were closed. You could only go there with an appointment. COVID, the lockdowns are finished everywhere, more or less. Shops are open, but banks are still closed. You need to have a rendezvous. But you need to have the appointment. You cannot phone. You have to do it via internet. You need to be digitalized. I go to internet, I don't get a response. And the only way that I got a response after 4 weeks is because I have 4,000, now I have 5,000 Twitter followers, and I tagged the bank on Twitter, saying, hey guys, how you going? The next solution was going to see Wim at EBF to say, can you help me? So it took me 4 weeks. And the appointment is in 2 weeks' time. So it means, I was not in an emergency situation, but can you imagine if I had an emergency? It was not possible to talk to a human being. This is not normal. This creates customer frustration. And I must say, it's because I trust the fintechs even less than the banks that I have not moved on. But just, and when I hear people saying it took me 2 months to have a new debit card that I lost. So really, I think it's a little bit a stone in your garden, maybe some food for reflection. This being said, what is for us the challenges from the consumer perspective has already been mentioned. It's of course the digitalization. It's the use of big data in assessing your customers, in managing your customers. It's of course artificial intelligence that is only as intelligent as the human being who has programmed it. And what I would like to say, in short, and then afterwards maybe we go further, the whole buzzword open finance. Now, from the consumer perspective, open finance should not mean open bar of consumer data. And this is really important. From the consumer perspective, digitalization puts consumers at risk in terms of privacy, of course, that's the obvious one, but also in terms of fairness, in terms of discrimination, in terms of exclusion. And that needs to be tackled if you want a trustworthy digital finance. So that's very important. A second point that I wanted to make is, and we already have mentioned it, the green transition or the sustainable finance. From the consumer perspective, there are two aspects there, because I heard a lot speak about investment and having the private sector investing, but I first would like to stress the fact that it will be the consumers who are going in a great part to, to make the green transition a reality, because it's the people who have to buy an electric car, it's the people who have to retrofit their houses, it's the people who have to buy a heat pump and put solar panels. If there is not a financing system that is sustainable and that is affordable for the people, it won't work. So the whole topic of green loans, I think, has been at the retail level now I speak, has been researched. And we need creative models by the banks that are being offered to the people so that they can afford to be part of the green transition. It's really key. And there I think that we need to have models, for tenants and landlords. We need to have pay as you save models, so that's not happening. And the second point is the investors, the retail investors. I'm part of the platform on sustainable finance taxonomy. I don't speak here as a member of that platform, I speak as an NGO here. But I see some of the members of the platform don't speak about green transition anymore, but olive transition, because now gas and nuclear is coming back, and we don't believe that that's maybe the most, let's say, ambitious way of getting the green transition done, but that's a personal opinion of the expert. But there is a lot of greenwashing going on, it's not going better, and that has two things, two consequences for consumers that are unacceptable. First of all, people want to be part of the solution. They want to invest into the green solutions, and by greenwashing, their money is being spoiled. This is something that is unacceptable. Second, they can invest into stranded assets. And that means that their pensions might be at risk, or the education of their kids. So this is really, it is key to have a sustainable finance taxonomy and investment, let's say, policy that is really ambitious when it comes to the criteria that are needed to be considered green.
Thank you. So it seems like there's a lot of agreement on the major kind of challenges coming up, but if we can maybe drill down into one of them in particular, which is digitalization. We've already seen the arrival of big tech into finance, and Augustine, you wrote a paper about this in August. So could you tell us a little bit about how supervisors and regulators can ensure there's a level playing field for big tech and banks? Oh, we can't hear you. I think you might need to unmute.
Yes, thank you very much. Thank you. I forgot to mute. I joined Monica also in congratulating EBA for the 10th anniversary. Hopefully, many more to come. Well, the question that you posed me is very, very important. I think that a point of departure in the argument has to be, in particular, what are the key characteristics of big techs that makes them so unique? And the main characteristics is the tremendous ability they have to process data. The second main characteristic is the fact that they rely a lot on networks, social media networks that give them tremendous access to households and firms to some extent, but mostly households, and that the interaction between data networks can generate additional activity, and that additional activity generates more data, fits into the network, and generates a very pernicious a cycle that we call it in the BIS the DNA cycle. It's data, networking, and activities. The real issue here is the speed at which this can progress, and at the same time, the fact that there are huge blanks, huge vacuums in terms of regulation that needs to be addressed. One is precisely the issue of the usage of data, and Monique mentioned it already. The other one is the issue of competition, because also what we have seen is that in very, very brief periods of time, payment systems in particular and some financial activities based on big techs can have a tremendous progress and inroads into very specific activities. In a way, in this case, speed is really what is very, very different from what we have done before. This story can get very complicated very easily. One is if these type of payment systems are made global, and there is technology to do that. I mean, if we look into the big techs, pretty much in their core activities, they are global. And we still have a major debate, a major issue among authorities. How are we going to grasp with this no man's land type of financial activity? And that is very present not only in big techs, but in many other fintech type of activities. very particularly in cyber currency, cyber assets, and so on. Now, something that is far more tangible and something that national authorities can address more forcefully is to enhance the coordination between financial authorities, authorities that are in charge of data, and competition. At least we should start talking among each other and try to put together a comprehensive framework under which we can bring some order to this process. Another very important element that could make this even more complex is if big techs come into operation together with stable coins, which again I fully subscribe what Monique said in her initial intervention, that many people aren't well versed in terms of what all this means. Stable coins are not stable. The main reason they need to be fully collateralized is because they're inherently not stable. And it depends on the degree of collateralization, the quality of the collateralization. This tends not to be subject to regulation, at least so far, and therefore there are some intrinsic risks there. So we have many things to discuss here. Going into a little bit more of a technical field, traditionally we have said a mantra that we have followed is same business, same risks, same regulation. That is something that we certainly need to put into play in all the different manifestations of risks. Initially, I would say many of these fintech and big tech activities have been regulated precisely following activity-based regulation. But my sense is that falls short of what is needed, because many banks, for example, have a level playing field. They also have entity-based regulation, and there are some issues about the operation of big techs that would also merit some entity-based regulation. So I think that we also need to move in that direction. No? So just I can go on for a long time here, but I would say the key aspects here is first speed facilitated by technology, by the tremendous availability of data, about the reach or the access of data that the big techs have based on their other main activities, social media, that generates this DNA cycle, and with the own level playing field, makes urgent that we move both in the financial regulation space, in the data space, in the competition space, trying to address this both with the activity-based and entity-based regulation. So I'll stop here so others can speak.
Well, let me pull in Sean there, because the EU is trying to tackle some of those issues. Activity-based, entity-based, what has the EU got planned? And Augustin mentioned stable coins. That is an area that you're looking into.
Yeah, thanks. Actually, before I say anything else, I should also congratulate EBA on their 10th anniversary. I was not only there at the birth, I was there when they were just a twinkle in Jacques Delosier's eye, in fact, but it's great to see that 10 years later, so much has been achieved and so much progress made. I think that the issue around digital is, as I said earlier, is about managing the opportunities versus the risks. I mean, it's nothing new in regulation. That's what all regulation to some extent is about. So we know what the opportunities are: innovation, efficiency, competition, choice, a lot of the things that I think Monique would want for the consumers. But I agree with her that with this comes certain risks for investors and consumers linked to distortion of competition, linked to protection. And then, of course, there are also, as we move forward, also financial stability risks emerging, perhaps not yet around this space, but certainly the rate at which it's growing, this part of the financial sector. There are certain concerns to at least keep it under close watch from a stability point of view. So, we've had a kind of change of philosophy in the EU in the sense that when this was all about fintechs, small fintechs, I think the view was that we should favor innovation by not allowing regulation to protect the incumbent. Okay, so we should give a sort of lighter touch to the small fintech, the small innovative fintech, allowing him to sort of innovate in the face of a larger incumbent in the large banks. That was all the PSD2 philosophy, the open finance philosophy as it was then. Since then, of course, we've had, as Agustin has mentioned, the emergence of big tech, which is a very different kind of discussion. These are large players, they're readily scalable players, and they kind of raise a different kind of challenge for regulators and supervisors in terms of managing that balance between the benefits of innovation versus the risks that come from innovation. We have tried to respond to that with, as you said, putting on the table, I think we're the first jurisdiction to put on the table actual legislative proposals. This is the famous market in crypto assets regulation. So we are ahead. We have followed the FSB principles, however, and we have responded to at least some of the issues that Agustin has raised. We wanted to take a rather holistic approach to the crypto space, so not just try to manage the way in which the assets themselves are offered, but also to try to regulate the service providers for those assets, so the exchanges, the wallets, etc. So we're trying to be as holistic as possible. Again, throughout this negotiation so far, we've been finding ourselves having to strike these balances between preserving the benefits of innovation while managing the risks from it, and I would say even different member states have different perceptions of that balance, and that has been part of the discussion that we've had around the table. We're very close to agreement now, I think, among the member states, and next we will have to go to the next stage, which is to bring it to Irene's table to also get her around the table to talk about their choices in terms of this balance. Quite difficult to do, I have to say. Well, what I will say here is that the problem we have with regulating this sector is that it's changing very rapidly. As I said earlier, it's growing very rapidly, but it's also changing. The offer from the sector is changing. So it's not just that the scale of these activities are rising, but the type of the activities is changing. And some of them, we speak about stablecoin and everybody thinks about Libra and, or DM as it is now, but there are other stablecoins out there, other stablecoin-like offerings out there, which are growing very, very rapidly now and are in unregulated space. So I think on the one hand, we need to get the regulation that we have on the books, proposed for the books, onto the books as quickly as we can, because these offerings that are covered by the regulation are growing very rapidly. More importantly than that, there are new offerings which I think may not even be covered by the regulation itself, and this is all this area around decentralized finance, or DeFi as it's called now, which is creating a particular challenge to regulators and supervisors because they at least purport not to have intermediaries at all, which makes it a unique challenge for regulators and supervisors. Now, I think myself, like others, we need to dig a little bit deeper into DeFi to see whether or not this is in fact fully disintermediated, or whether there is in fact an intermediation or intermediary involved in this decentralized finance as well. But it's just one example of how I think this sector is moving so rapidly that it will be very difficult for regulation and supervision to keep up, and we will need to move very, very quickly. So we hope when we get this piece of legislation through the council part of this process, that we can keep the momentum and get these rules on the books as quickly as possible, because as I said, the sector is not only growing, but it's evolving very, very quickly.
Irene, can the European Parliament help with that, get the regulation onto the books quickly in terms of DORA and MiCA?
Well, yes, we are working on these files. I'm happy to hear that there are some good news on the MiCA file, and because we know that there was some slowdown related mostly to dynamics in the council, but it is complex, and it is exactly what John said. It's not easy to regulate phenomena that are dynamics and constantly change. So on one hand, they are new, so you are forced to regulate things that you are still learning, especially for policymakers, still learning how they're working, what the full impact could be, not only the full impact of the technology, but you need to understand what the full impact of the regulation would be. Because as John said, you want to regulate, but you don't want to stop innovation. You don't want to be an obstacle to innovation, but you want also to provide a framework that allows this innovation to be a good one and not to provoke risks or distortion. So this is a very fine line. And now I just want to remind that we are already in trialogues on another piece of the digital finance package, which is the DLT pilot regime. And this is an example on, I think this is a very good approach. I'm sorry, the distributed ledger technologies. I'm sorry, because we are so used to all these acronyms, and we give it for granted that everybody. So a distributed ledger technology pilot regime, which is the idea is exactly this: provide a space to experiment, to see how things go, what the impact could be, and adjust the regulations and the framework accordingly. So we are trying to deploy all the possible instruments that we have, but of course it's not easy. But if I may, just to reconnect to what Monique said earlier, I think that while doing this, in this difficult attempt to balance these challenges, of course, we need to take into account the need of innovation, new technologies, new startups, the need of financial stability and lowering the risk, but we also need to take into account the needs of people. And it's true, I agree with Monique, sometimes we don't think enough about the human element of what we do, and we should do it more often, because after all, if you think about it, the banking industry is not just the business is not about the business of lending or managing money, but it's about building and managing trust that people have in the institutions. And we need to remind that when we do regulations, when we, for both for legislators and also for the banks and the people who work in the industry, we need to get and reestablish and maintain the trust that people have in these institutions. This is fundamental, and we are trying to do that. And for example, just to give you an example, and then I'll try to be very quick. I know that the time is limited, but when we negotiated the directive on NPLs, on non-performing loans, we tried to introduce these elements. When we think about NPLs, it's not just a piece of, an item in the balance sheet, but it's a relationship. It's a relationship with the client, with the customer, with the citizen. So before just, of course, we need a well-functioning secondary market. We need that, and we try to have a regulation that allows for that. But we also need to make sure that the person, the human being that's behind this contract, gets all the guarantees, the information that they need, and that has the possibility to renegotiate. And that's why we insisted so much on the forbearance measures, because this is how we can maintain this trust in the system, in the banking institutions, and we will keep, I will personally fight to keep this approach, because I think this is important. This is really the core, the real business core of the industry, is this trust and the relationship. And this is not conflicting with the profitability, or because if you think about NPLs, I think every banker can agree on the fact that trying to work an NPL and turn it back to performing, it's always better than just selling it out on the market. So making an effort to see how we can renegotiate, make it performing again, helping the person to go back to paying. It's a win-win. So let's never forget about this dimension of the industry, because this should be the guiding star of our action as legislators.
Thank you. Hopefully we'll have time to come back on NPLs a little bit later. But Monique, I'm going to suggest that you probably agree with putting the person first when it comes to financial regulation. But if I could ask you, the EBA as well recently came out with a report saying that there's a risk that banks become too reliant on digital finance to reach their customers. So you gave the example of actually trying to reach your bank in particular, but in some ways, is there more intermediation in the middle of that anyway at the moment? Is that a risk?
First of all, I think that what Irene just mentioned is music to my ear, because I wanted to say it. I really believe that in the midterm, people will be totally fed up by automation. And the winning business model will be human intervention. Because you need it at the end of the day, because people realize over time that they're making bad choices because automation does not take sufficient account of their personal needs. So the investment, be it by banks or by any other company, in advising people in order to also build the trust, for me, will be the winning business model. But that means, in terms of regulation, that for the moment, what we need to fight for is to have the right for human intervention when decisions are being taken by a robot that where your life depends on. I mean, I don't speak now as a patient, but as for example, somebody who wants to take out credit or who wants to take out an insurance. So you should, as a person, have the right to have somebody, a human being, who has some freedom of discretion to overrule what a machine has decided for you. This is really something that is very important. So it's intermediation, in fact. And I also think, let me be another layer of vintage. I really believe that if you play in the playbook of digital finance and a cashless society, you're doing harm. Because you are going it's about competition. You are playing into the fintech, into those who just want digital to be the only way of payment. So keeping an offline world, an offline market available for the people is also keeping competition in the financial market. And that's something, I mean, in those countries like in Sweden, where now we have, which is the most cashless society, they're coming back. They are now introducing regulation for a minimum of cash that needs to be available. So I really believe that that's very important. What I also would like to say is, I totally agree with what Agustin was saying. Big tech has what we call the network effect. They have a competitive advantage because they have data about you that has nothing to do with your financial life. We believe that most of those data have been collected infringing GDPR, meaning that, in fact, the enforcement of GDPR is not strong enough. And there, when you say, then, Agustin, you need to work together, financial regulators, competition authorities, data protection authorities, consumer protection authorities, this is the way forward, because together there is a wealth of information and intelligence that might tackle fintech, because they don't abide with European legislation. Don't speak about financial regulation. They don't. I mean, we are in court. My members are in court in many, many cases against them. It's a nightmare because they have so much money, they can delay any court action. And there, another thing I would like to suggest, talk to the American regulators. Now, Biden administration has put at the head of consumer protection, Financial Protection Bureau, CFPB, a person who knows a lot about consumer protection in financial services, and it would be great if, because the fintech are mostly US-based, they really have no culture of complying with European procedures, so let it go at the source and get them being regulated there.
Okay. Just to pull in a question from the audience as well, so a topic that I was hoping to touch on, but this is from Martin Schmaltzried, I hope I've pronounced that correctly. How do you see central bank digital currencies affecting the banking sector? Would you support a CBDC which emulates the characteristics of cash, i.e. it's anonymous? The ECB is looking into a digital euro. Augustine, is this a trend over the next 10 years?
Well, I would think so. I think we have to start with you know, why have we been discussed CBDC so intensely in the last 2 years? There are CBDC that are meant for wholesale purposes. I think that's very important. That will become more relevant, in particular, if we realize that stable coins are used mostly for wholesale purposes in trying to avoid the use of regular RTGS or other type of electronic type of money. But I think that we need to make progress with wholesale CBDC because at the end of the day, it's most trustworthy than stable coins. But I think at the retail level, and I think that is where the question is going, in particular when they make the comparison with cash, I think at the end of the day, society is asking for a different representation of money. They want to have trusted money. They want to have central bank money. Now, today, the only way they can get central bank money is through cash. Now, I completely agree with Monique and others that have commented that we should not eliminate cash. I think cash should be there, should be available. That option should always be present. But there is fair amount of members of society that would want to have a different representation of money, would want to have the unit of account to be fully backed by the institutional capacities and rules and regulations that regulate central banks. And most of these operate as it's commonly known. I mean, usually central bank money is dealt with the banking system. So I think that we need to build a CBDC system, a retail. It's talking a little bit in technical terms, it should be a two-tier system where I would say the customer-facing part of the CBDC could be operated by commercial banks and probably by payment service providers. We would be using some of the abilities and the capabilities of commercial banks that central banks do not have, and that would provide a very good opportunity to precisely provide society with a better representation of money. People want to have this type of money, and it would be a pity that the only alternative would be one that is not issued by the central bank. Now, yes, it could, under different scenarios, represent competition for banks. In particular, if people can have access to the resources electronically, central bank money, they probably would not need to use many payment facilities that run on commercial bank money. But so I think that element of competition is also adequate. I mean, I think that we also have to realize that many of the services that commercial banks provide could be made more efficient, and therefore some competition from central bank digital currency could be adequate. At the same time, it should not be undue I would say competition. It could represent at some point some financial stability risks, especially in the cases of weak banks that could be easily runs. And therefore, we need to be very mindful about how are we going to parameterize the different aspects of CBDC. My own take is that we can have an adequate design in such a way that we can provide to the people CBDC, which is, again, a different, more modern representation of money. This should not mean the elimination of cash per se. We need to give the options to society. We should try to make this work with the commercial banks as the main actors. And we need to establish a right set of regulations and parameterization of the different principles that regulate the CBDC so that we can have a win-win situation, no? In which the needs and the desires I would say the public interest is preserved here without harming unnecessarily the banking system. I also think that CBDC is of the essence precisely to compete against stable coins and other cyber currencies. You know, I think today there is a vacuum there, and it's being taken advantage by the stable coins. Stable coins have a weakness from design. I mean, if you have a currency that needs to have in its name the word stable, and that stable, the concept of stable is imported by using a fiat money, well, the logical thing is then why do you need stable money if you can go directly to fiat? Now, the issue is that today, for some usages, you might not be able to go directly to fiat or to central bank money. Therefore, our task is precisely to provide money, central bank money, with the technological representation that society needs. So I think I'm all for it, but we need to be very mindful. And yes, there are very important challenges to solve, but I think this can be a welfare improving move in many respects. Thank you.
Sean, if I could throw that over to you. I mean, the risks for the banking sector, perhaps, in terms of central bank digital currencies or stable coins, is that something the Commission's worried about?
Well, worried is probably a strong word. I mean, I think we are working together with the ECB on the technical aspects of this. I think ECB is proceeding slowly. I think that's correct, and carefully. Before I turn to this, let me just go back to something Monique said, because I always have to answer this. I mean, the idea here, I think, as Augustine was saying, is not to create a cashless society. The whole idea of the digital agenda is in fact to preserve cash, but at the same time respond to what is a growing demand for digitalized services in the economy. Now, maybe it's a question of age. Maybe when all of these young people get older, they'll want more cash. But today, there is clearly a demand, but an intergenerational demand for more digitalized services. So it is not a question of displacing cash. It's a question of expanding the sort of universe of digitalized alternatives that will be out there. Cash will always remain where it is. Now, on this relationship then between a digital cash or digital euro, digital current central bank currencies to the banks, I mean, the way I probably see this is that it could be an important anchor, a digital currency from the central bank. So a digital central bank currency, or digital euro in our case, could be an important digital anchor to what is digital commercial money. Okay, so this is important to have that. So it plays the same anchor role it plays today with commercial money, but in digital form. So that's what we are thinking. But of course, we have to be very careful that this digital central bank currency does not start to disintermediate the banking system, does not start to displace commercial money to a point where it becomes the dominant form of transaction, either in normal times or in stress. Because this is not the role of central banks. This is not the role of central bank money to sort of displace commercial bank money. So I think we have to be careful that we get the balance right, that it's the anchor, but it doesn't start to displace. And that's why you have all these discussions around whether there should be caps, particularly when we talk about retail currency, whether there should be caps on the amount of that digital currency that can be held, because this is this attempt to have it there as an anchor, but not to allow it to grow to the point where it starts to displace the intermediation role of the banks. Now, the way we have looked at this, I mean, we have kind of three objectives around central bank currencies. One is, as I said, to meet this demand for digital cash. It is out there, whether we like it or not, it's there. Second is, at least we in the Commission see it as a way of perhaps, as I said, anchoring and therefore leveraging this broader digital finance agenda that we have. So it can be an important element in kind of fostering a wider digital finance agenda. And then thirdly, a point that Augustine has kind of alluded to is all around sovereignty, because there are some possibly very large private sector alternatives out there which could ultimately, I would not say displace fiat money. It's not going to displace fiat money in this part of the world. In other parts of the world, it could easily do so. But it could certainly complicate the operation of monetary policy if it was to become the dominant source, or even a dominant source of transaction finance. And it could create, even ultimately could create stability risk. So there's a sort of sovereignty issue around this as well. I don't mean that sovereignty in terms of national sovereignty, but the sovereignty of monetary policy. So I think we have to kind of weigh all of these factors up, and it's again, as Irina mentioned, is another very complicated part of this story, because we're learning as we're doing. In fact, we're not even doing, we're learning before we're doing, because it's conceptually very difficult. On the question of anonymity, I think we should not confuse anonymous with private. Okay, digital cash, digital currency will always create a trace. It's inevitable in the system. There is a trace. It's the way it is. It cannot be anonymous, but that trace can be private, of course. You can control who has access to that trace, who has access to that data. And that creates a wonderfully interesting discussion, of course, around money laundering and anti-money laundering efforts, because, of course, that trace is a very interesting, how do I say, advantage of digital cash over physical cash, which is truly anonymous and is extremely difficult to trace even for legitimate purposes in the system, whereas digital currency will allow legitimate tracing. The question, of course, and I'm sure Monique is going to raise this, is how we ensure that any tracing of what is private data is in fact legitimate and doesn't sort of become illegitimate and become a problem for data privacy. I'll stop there.
Okay, well that sounds like I should throw that over to Monique. To avoid spending the entire panel on digital, because I think we really could, I'll just also add, just maybe throw in another topic, is crypto. We've seen that's also an area with consumer risks. There's been warnings from the EBA. What more could be done there to protect consumers?
I have to say, we don't work so much on crypto because we have limited resources, but we are very concerned, of course, because people take a lot of risk buying into the hype. What I would like to say, if I may, to Sean, I think that digital skills are not a question of generation, they are a question of age. Meaning that it is with, because even if the digital natives are much more comfortable with digital tools than, let's say, the older generation, it is with age that your fine motricity, playing around on a smartphone, and your cognitive skills to adapt to all the new software that is being proposed are diminishing. And that's where the people with aging people have a problem sometimes with the digital tools. Also, I accept that you say that, of course, it is not the wish of the policymaker to go for a cashless society. But if that is true, you need to protect people against the market that might push towards a cashless society, because that might be easier for the financial institutions. Because what we see now is that banks are closing branches, again, Wim, sorry for that, closing ATMs. It is more and more complicated to get access to a machine, to get your cash. So, and then of course people go to the digital solutions, and then the bank saying, oh, people don't want cash anymore. No, it's because you're being, I mean, you know, it's like, who is the egg and the chicken in that story? And so it is really important then to provide for a regulatory framework that gives the right to cash, to some extent, a geographic distribution with minimum number of ATMs, no discrimination. You don't need to pay for the money, that is your money, as long as it is in your own branch, for example. So that there is really need to have something that needs to be, to have access to this, let's say, non-discriminatory way of payment. And we are in favor of the digital euro, so we are very much in favor of the project that is being, for the moment, managed by ECB and the Commission.
Irene, if I can just bring you in for one last question on the digital finance side. In terms of supervision, is it important to get it right on crypto and cloud services? That's really up for debate in the European Parliament at the moment.
Yeah, of course, this is in the past year we've been debating a lot on that, both relating to the MiCA, DORA, as I mentioned earlier, which have been a big debate. Crypto assets is a big concern for members of Parliament, especially related to both the issue of financial stability, but also the issues that John was also mentioning earlier on fraud, anti-money laundering, and I think that on this front, the Commission is moving in the right direction, and I think here we need to think about how to regulate issuers of cryptocurrency. There is also an interest, of course, in the digital currency on CBCD, as we were mentioning. I know you wanted to close. We've talked a lot about that, but we've been debating about that in Parliament as well. Of course, it's not something we are working on actively, but you know that there is the project from the ECB. So we've had Panetta referring and reporting to us the developments of the project, and there is a lot of interest. Of course, there is an enthusiasm, but there are some worries for the Parliament. Mostly is related to issues related to safety of the instrument, about privacy, which it's true, it's not anonymity, but it's how all these, this huge amount of data would be handled, how can be protected, possible cyber attacks. But there is also a lot of interest in the potential of this instrument, also in relating to fighting frauds, anti-money laundering, it's a very important debate. We are following closely what it is going on. It's not easy, as we said earlier, to know exactly how to move, how fast to go, because if regulation moves too fast ahead, you risk hampering innovation. But if you lag behind, you risk, creating the space for risks, and we don't want to do that. So I think it's important that we are putting a lot of attention. I think that the Commission is quite at the forefront of this debate, and we are very well coordinated in this debate, which is of course ongoing.
So another area that's getting a lot of attention is obviously climate change and the fight against climate change. The Commission came out with its Sustainable Finance Package in July. There's a lot of focus, and we're expecting perhaps more focus on this tomorrow in the Basel package, on ESG risks, on making those more uniform, on incorporating them into banks' risk management. But Sean, the European Court of Auditors has said, that's not enough. This isn't going quickly enough to change capital flows. What do you say to that? Do you need more kind of punitive capital requirements or other measures to kind of facilitate a shift to greener finance?
Well, I think I've answered this question quite a few times, maybe also when you were present as well. I mean, I think this is all really about a matter of moving as quickly as we can, as quickly as possible, but as I say, not faster than as possible. Okay, so because if you go faster than as possible, you create problems. So we think that the way in which we are approaching this, and the way in which we approach it in the strategy, and what we will do in the package tomorrow, which I will not talk too much in detail about today because it's to be decided tomorrow. But I think what we're doing is trying to work with the market. I mean, there can be no doubt that across the financial system, and across the investor base, there's already a shift towards green. So it's not that we have to sort of generate that shift. We need, of course, to work with it. And so we think that what we're doing is already sufficiently ambitious. We are asking the banks, and we will mandate the banks to incorporate ESG into the way in which they manage their risks, both inside out and outside in. But we are not going to sort of overdo it, because I suspect that if you pressurize the system too much, if you push too much, too hard, too fast, what will happen here is that we will destabilize rather than work with the market. And if we destabilize the market, of course, we will never achieve the objectives that we want. So the trick here is to be ambitious to move the system as quickly in this transition as is needed to reach 2050, but to do so in a way that you don't destabilize it, in which case, of course, you'll go completely off track and we will never reach the 2050 targets. So I am aware that there are those who think we should move faster, we should move more aggressively, but we think we have found the right balance to ensure a sort of steady, stable, and ultimately successful transition towards 2050.
Augustine, what do you think about the global level? Is progress fast enough? We have COP26 coming up. What would you like to see there? Oh, you're on mute again, I think.
Well, definitely, we all want to make progress in climate change, but I'm pretty much in the same camp as John. We need to get it right. You know, I mean, sometimes in many fields of public policy, it's better to go at an adequate pace to avoid mistakes. And it's not only mistakes from the point of view of what just said, that you might destabilize markets, for example, or financial markets, but also you can generate different consequences in terms of transition, in terms of markets, in terms of, for example, energy availability, that might, at the end of the day, reduce the social support for the aggressive fight against climate change. I think we need a lot of work to do ahead of us. We need to be much better at linking the consequences of regulatory measures with the final objective. I mean, right now we sort of have some common sense idea that, you know, if you make it more expensive for example, oil exploration, you will help climate change. But we don't have the direct link of the financial regulation action to the final objective. So all goes through intermediate objectives. And the same goes in terms of capital markets. The same goes in terms of ESGs. You know, how does these ESGs and is mapped into characteristics of corporations, and how is that the performance of the corporations at the end of the day linked to the final objective of combating climate change. So I think that we need to do far more work on this. In terms of the stabilizing that John mentioned, we have mentioned here at the BIS the risk that at some point we might have a green bubble. You know, we're creating all this frenzy about investing in ESG-related corporate instruments, but there is a lot of appetite that is being reflected in asset valuations. Now, if we really are not absolutely sure about the links of the actions that the corporation are taking with the final objective, at some point there might be disappointment, and that might not help the development of markets and the financing that we need. So we need to work more on taxonomies. We need to work more on understanding how the different measures affect climate change, and in that way have a far more focused and appropriate set of regulation. So we need to work together, we need to work fast, but we need to be very prudent about the steps we take.
Irene, do you agree with that? Being prudent, working through taxonomies, is that ambitious enough faced with the threat from climate change?
Well, of course, it's, you know, sorry, I'm just responding to Augustine. Of course, most of the actions we are taking are intermediate. I mean, they don't have a direct impact that is measurable on climate. But this is about everything. When most of policy actions that we put in place are oriented to affect behavior of people, behavior of companies, trying to steer this behavior towards desirable outcomes. This is what policy making does, and we are working on several levels, at different levels. So the taxonomy is important because it gives some clarity in terms of defining and measuring certain what can be defined as sustainable, which was something badly needed, and so can help us, I think, greatly providing clarity. We've been working a lot on disclosure because that's also important. So to provide clients and investors with transparency on what are the products, the transparency all along the financial value chain. We are working right now in Parliament. We have the Corporate Sustainability Reporting Directive because, of course, the transparency and the disclosure has to be applied not only to financial institutions but also to non-financial institutions that are engaged in economic activities that can have a strong impact on the environment and on climate. So there are different levels. The SSM is working to look to see how the risks coming from climate change can affect banks and how could be in the future incorporated. Next year we will weigh the supervisory stress test with a focus on climate and environmental risks. So as you see, we are working on many different fronts to tackle this issue in the best possible, most comprehensive way. Is that enough? Could we do more? We are doing what is possible, considering also all the political issues, all the not only political but also issues related to the real economy and the timing needed for the transition. So as legislators, we are dealing with these problems every day. So we push for an outcome that is desirable and we want to achieve as soon as possible. So the climate neutrality, but on the other hand, we know that this transition involves entire industries and companies, and this means involves jobs, people, and family, and that's why we are trying to accompany all these activities also with investments for the social dimension of the transition. And actually, we have tried to do something as a social taxonomy, which would go in parallel with the environmental taxonomy, but we are lagging behind on that. But just to give you an idea on how complex the issue is and how different are the levels at which we have to work. And I can't tell you whether it is enough. What I can tell you is that we are doing the best that we can because we are aware that there is no time, and we need to push on this, and we need to provide with the right instruments. Of course, legislation has to be good, so we make all the efforts to make sure that we have the good balance of what is desirable and what is possible. And this is the difficulty of our job, but we try to do that because we can't hide the issues that we have and the challenges that we have on the sustainability.
Monique, you mentioned earlier the idea of the olive transition. So is there a risk of getting it wrong if these don't work their way through? But before you answer, there's also a question that has got a lot of votes on the chat as well. You said that we need to offer consumers a model to allow them to be part of the transition. So how do banks and financial institutions incentivize households to take up green loans?
Whichever one you want. First of all, maybe to respond or to react a bit to what has been said. I mean, I'm normally a very optimistic person. You need to do that to do my job. And in fact, but here I'm quite close to despair, really. No, really, I mean, really. I mean, we are speaking, and I know the Commission has done a great job, not only on the sustainable finance, but also on the Green Deal, the circular economy, the chemical strategy, very courageous, having a lot of proposals. When we speak about the taxonomy, we don't speak about banning anything. We speak about classifying things. And that has given rise to a battle of lobbyists. I mean, rear guard. We are speaking about the end of our civilization, huh? Don't forget that. Yeah, I'm serious about that. And so I really believe that there is lobbying going on, and not only from companies or from associations, from governments also, that is really putting us at risk. We don't need an evolution. We don't have, like Irene said, we are in an emergency situation. We don't have a decade ahead of us to make change. We need disruption. And I'm not the person who is for disruption normally. I'm not going, not going to hang myself at the Berlaymont to show that I'm not agreeing. I try dialogue. But here I really think we need much more political courage, because, and disclosure is not enough. With disclosure, you put the responsibility of the wrong choice to the people who are going to take the risks, and that's the retail investors, for example. So I really believe that we need, this is not enough. We won't get there, and we really need more courage. I don't blame anybody, certainly not, but I think that some lobbyists should do some, and governments should do some introspection there and some soul searching, but I cannot do that for them. And then on the question about how can green loans, first of all, how can green loans be more affordable? First of all, there is, of course, maybe something that can be done in terms of prudential. Maybe the capital requirements can be adapted to incentivize the banks to offer green loans. I'm not a specialist on that, but there could be maybe there an incentivization for the bank sector. There could be an interest cap, rate cap, that could be so that consumers are really pushed into green loans. There could be also totally creative, it already exists, but it's not really mainstream, like pay as you save. You know, you have a reduction in your energy bill, and that allows you to pay back the credit for installing a heat pump. And I mean, you always speak about innovation, so I count on the banking sector to be innovative, to provide green loans to the people, come up with it, and it will certainly work. People are waiting for that, because they cannot fund it themselves, and there is a big but. I mean, there will be, you know, the energy poor, there will be a lot of social measures, maybe even the recovery funds will help. The rich, well, maybe they don't necessarily need it, but there is the huge middle class, which will be the critical mass who will make it happen. Otherwise, we will fail. And it's in the mortgage area, or in the, let's say, the retrofitting area, that there is the biggest potential for people to make a change in terms of CO2 emissions.
I think we could keep talking about this for a long time as well, but just because it would be remiss not to ask Sean about Basel III before tomorrow as well. So I'm imagining you're going to say there's not much you can say, but in terms of your goal of both balancing international commitments and limiting the capital increase, do you think you've achieved that?
Well, I shall leave you to judge that. I mean, when you see it tomorrow, I mean, you already know that much of it is being trailed in the newspapers, so you already know to some extent what is there. I think so. I think yes. I mean, the commitment we made was to deliver on time in a way that was consistent with what we were required, which was faithful to the commitments that we had made. I think we will do that. We also had a commitment, of course, to avoid a significant increase in capital. I think we will also do that. And we will do that, all of those things, while taking into account the sort of specific features of the EU banking system, which is necessary, of course, because of the way we apply Basel. We apply Basel to all our banks in ways that other jurisdictions do not do. So I think, of course, I will be biased because I am a proposal coming from the Commission, but I think we will meet all of those things. And I think when people see the numbers and see the way we have structured it, they will, I think, accept that this is not this sort of feared huge imposition of capital requirements on the banking system, but is a carefully managed, carefully calibrated, but important improvement in the sort of prudential framework for banks and in the solvency of banks under that framework, but done in a way that's not going to, I think, cause too much problems for the banks overall. So that's, I will not go into the details, as I tell everybody all the time, the closer I get to decision day, the less I can speak, because I prejudice the decisions of my bosses. So I leave them to decide on the final details of the package. But I think when you see those final details, we'll have met all the commitments that we made in the Basel Committee. And
Augustine,
I hope Augustine thinks so as well when he sees it.
that was my next question. Augustine, how important is it for the EU to apply these reforms faithfully? How much, at an international level, can you allow any sort of deviation for EU specificities? Or you're on mute.
It's extremely important. I mean, the Basel agreements, the Basel principles, comes from a very important thought, and that is that it's much better to have a cooperative solution to a problem of the problem of avoiding the necessarily avoidance of enter into competition through a regulation, no? So it's important to have a level playing field. It's important to have, let's say, a minimum set of common rules on which to operate. And it has taken a long time. It has taken a lot of effort. Europe is extremely important in all of this, and I'm sure that John and others are very aware of this. And what is very important on a practical level is if there is a significant deviation of the spirit of Basel III, and it is sort of justified by the singularity of a region or a country, it's very difficult to keep only at a single level, you know? So because then you start a debate of why them and not me, you know, and that can really take some traction away of the set of principles that have been achieved so carefully. So I hope that tomorrow we are pleasantly surprised by what will come out. Thank you.
So we are coming towards the end, so if there are any questions from the audience, please do flag. But if I can ask, Irina, you mentioned at the beginning non-performing loans, which is something that you've done a lot of work on as well. You know, we are looking ahead to the next 10 years, so is this going to be a problem? Do you think there is enough, the file that you recently worked on secondary markets will be enough to help both banks and consumers?
I think a lot has been done already. I think that what we are seeing, of course, it's impossible to predict the future in this industry, especially it's we never know. But I think that what we've seen in this past year is quite comforting, because a few months ago there were many who predicted a complete disaster and the explosion of NPL. So we were very worried about that. Even when we started to work on the directive, we did it, with this fear. We are working on something and we need to work and fast on these, because this problem is going to explode. It didn't happen. The banking system showed high resilience. It's true that we've seen also a lot of public support all across the union, but it's also true that now it's been several months since the public subsidies and help have started to be withdrawn. So we should have seen, if the problem were there, we should have seen it already. And so far it's going pretty well. So I think that the industry, the sector has shown resiliency on this side. In general, the European economy has shown great resiliency. But of course, we have to, keep an eye and keep very, be very careful and monitor carefully what will happen and be ready. But so far now we will have other pieces of regulation also regarding to this topic, and we will be working on like CCD. I think that the banking system has shown quite good resilience. This is also due to the regulation that was adopted in the past. Also, pieces of legislation for which banks complained a lot, but then eventually proved out to be good pieces of legislation. So I hope that we will have something like this tomorrow, a piece of legislation that helps our banking system to be resilient and to be competitive and to take into account all the, I know how difficult it is to balance all the different needs, but I think that so far the Union, the past few years, has shown a very good direction.
Monique, you just leaned over and said energy prices. So is that a concern going forward in terms of NPLs?
Well, from the consumer perspective, of course, we are very concerned about, and we are going to monitor that very closely with our members in the different countries. Energy prices are going up, and I mean, they are expected to maybe go down again in the spring, but let's see how that is working, and that could really put quite some households in difficulties. Because, I mean, I hope you are all prepared to a price increase that is quite important. It's several hundreds of euro, depending on the country, of course, and some speak even about more than 2,000, for example, in Belgium, for an average household. So that can really disrupt also the possibility, of course, for people to be able to repay their credits.
Okay. Any questions from the audience? There's a question over there. Thank you.
Yes, thank you. Happy birthday to the EBA. But also maybe a question for the panelists. How do you see the EBA in 10 years? Will it still deal anyhow with AML? What will be its relation with SSM? Small question.
Who wants to jump in on that one? I'm going to have to pick. Sean.
Thank you for that. I see the EBA still very much there in 10 years' time. Okay, we are creating an anti-money laundering authority, as you know, but that's because we intend to expand massively the sort of activity that is done at the center in the area of AML. So this will be very far beyond what the EBA is doing today. So this is a different discussion to the future. It's not something which, in my opinion, fundamentally affects the EBA in the large part of its activities today. I think what's really important for the EBA now is to move, I hope, from with this Basel package in place, from what I think is the last part of the sort of large-scale regulatory agenda we have. I think now going forward, the agenda for banking regulation will be there still, but will be not of the order we had since the great financial crisis, and focus more on two aspects. One is the convergence of supervisory practices. I think that is really important. They have a very important role there, and also in terms of consumer protection. And I'm pretty sure that Irena and her colleagues in co-legislation will continue to require plenty of level 2 activity around the Commission and the agencies, and so I imagine EBA will be kept busy in developing its rule book as well. So I think the EBA has plenty to keep it busy for its next 10 years.
Great. That's almost a good point to end on, but I guess, Monique, if I could ask you as well on consumer protection, do you think the EBA has more to do over the next 10 years?
Well, I hope that the EBA wants to do more and has appetite to do more. I would certainly welcome I mean, not better use, because I mean, this is something that needs to be developed, but use of intervention powers or mystery shopping to see a little bit how the capital market or the banking union looks like from the consumer perspective. And I would also really welcome more interaction with the other authorities. It has been mentioned, data protection, consumer protection authorities. And you know, the markets are more and more integrated. You can have also very good cooperation with, for example, the energy regulators, or the telecom regulators, because they all have this struggle of having a digitalized ecosystem that they need to work with, and where you have the same companies that you need to address.
Okay, any other questions from the audience before we wrap up? Okay, I guess if I could just end with one final question. We are looking ahead to the next 10 years. What would you really like the banking sector to look like in 10 years' time? If I could ask the panelists, what would be your vision? What should it look like? What would be a healthy banking sector? Or I'll pick on Sean again.
What would a healthy? Well, I think what I'd like to see is a banking system that is still, well, of course, it has addressed its structural problems that I mentioned at the beginning. So is now profitable. It has addressed the structural issues of overcapacity, inefficient cost structures, etc., and is still a very important part of a diversified financial market. So I want a capital market there, but I have never seen this as a trade-off between the banking sector and the capital markets. I see these as sort of almost symbiotic. And so I'd like to see the banking system as a strong part, an important part of a diversified system. I'd like to see it embrace these opportunities of digitalization and not be somehow, displaced by them. I think that would be something I would like to see. I'd like to see them also leverage the sort of green financing opportunities. I think Europe has a great opportunity to be a leader in green finance. We are in the lead already, but that does not mean that we will just sit and have that leadership. We have to build it, and the banking system will be part of that process of establishing the EU as a leading jurisdiction for green finance. So I'd like to see it do all of those things, but I think that will require work by the banks. So the banks will have to address these structural problems and embrace these opportunities. But also, of course, from the policymakers' point of view, we have some work to do as well, because as I said at the beginning, we'll need to make sure the context is right. And for that, at the risk of repeating myself over and over again, I want to see the banking union completed, and I want to see a lot of progress in capital markets union. I think if we can do our part on the policy side and the banks do their part in terms of their internal structures, we'll be seeing a vibrant banking system in 10 years' time, for sure.
Irene, we haven't really managed to touch on the banking union, but what would you like to see in 10 years' time?
Well, exactly what I said at the beginning and what John has mentioned now. I mean, I hope that we will manage to complete this banking union, of course, along with progresses on the capital markets union. And I really hope that all the member states and the national authorities will realize that this is not a limitation to any national prerogatives, but this opening up opportunities for everyone, is making the European Union stronger, making our companies and our banks stronger, more competitive. So I really hope that we will manage to make progresses, to see more cross-border activities, to see more integration, to see stronger supervisory at the European level. Augustine had mentioned in one of the previous interventions that he would like to see more coordination between national competent authorities. I think when we were talking about maybe crypto assets or something like that. Well, that's true. We need more coordination, but I think we need also a stronger and more integrated supervisory activity at the European level. This is a long standing battle of the European Parliament and of the Commission as well. We would need really to push on these fronts. It's everybody's interest. It's really a win-win for everybody, for the European Union, for banks, for companies, for member states. I hope that the sooner everybody realizes that, the better.
Augustine, stronger supervision.
And if I may add, sorry, but also, all the projects that we are talking about, what we love talking about, related to the transition, the digital transition, the new Green New Deal, the recovery, next generation EU, etc., now are involving a lot of public investments, but there is no doubt that public support, public investment, public money will not be enough to support this transition and to achieve all the goals that we have in mind and that we want to achieve. So we need to have a well-functioning capital markets, banking sector that allow also the real economy to participate to these achievements and to achieve these goals. So I really, I'm sorry. When I talk about these, I tend to overreact. But really, that's the Europe that I see in 10 years is a Europe that has realized how important it is to have a real union on all these fronts.
Good to have some passion. Augustine?
Yes, we need a vibrant, safe, strong banking system through time, the banks have been a key instrument in society to reallocate resources. And if we think about the challenges that society will face in the next 10 years, they all involve huge reallocation of resources. Let's just take, for example, climate change and the digital revolution. We need in society to reallocate resources in very specific ways. The best way of doing is to well, of course, with the adequate public policies in place, but a key instrument to move resources across sectors and across time is the financial system. And the key player in the financial system is the banking system. So I think we need the banking system. We need a strong banking system. In this conference and through time, in the recent years, there is a lot of diagnostics already what needs to be done in Europe. I think the diagnostic is there. I think you need to move. I think that we have been waiting for the banking union, capital market union. I think it's time to act. And I also think that at a more micro level, I think that there is this sense that, and Monique mentioned a little bit something of this, that in many aspects, there is this conception that to deal with your bank account or with your bank it's a real pain. I think they need to change this. And I think technology can help them in that. I mean, I agree with Monique that the personal touch is very important, but it should be a mixture of technology and personal touch. Why big techs are so popular in many senses? Why they can move so fast? Because people access to a financial service not through a web page of a bank, but because it's a web page that is part of their life, you know. I mean, WhatsApp is part of their life, Facebook is part of their life, the different Alibaba or different web pages, social networks is part of their life. An additional service is financial activity, so they don't necessarily relate the access of financial services to a financial institution. I think this is a challenge that they need to work towards. People should be happy to go and interact with the commercial bank. And I think there is a lot to be done there, and I hope that they move in this direction.
Monique, do you want to give us a thought to leave it on?
Agustin, if you want to change job, I might have a vacancy maybe. Well, I think I'm going to say what Agustin said. I think that I would say maybe that banks should reinvent the customer first concept, that they should consider themselves as being advisors to their clients, that they stand next to their clients in order to advise them to their best interests. It's also about non-biased advice when there is any financial advice that needs to be taken. I think there should be a rehumanization and a partial digitalization. That's a difficult one. I totally agree, digital is great if you keep it under control. And I think that the human touch might be the winning business model in the coming years. Thank you.
Great. Well, thank you very much to all my panelists for a really great discussion. There's clearly plenty of challenges ahead, but some thoughts to get us underway. So thank you very much, and I'll hand back over to Franca.
Thank you, Hannah, and I would like to thank all the panelists. And we are reaching the end of our conference. We will now be joined by our Executive Director, François-Louis Michaud, who will make his concluding remarks and close the event.
Thank you very much, Franca, and thank you all for attending this event, ladies and gentlemen, dear guests and colleagues. It's a somewhat fearsome privilege to close what's been a really inspiring and stimulating afternoon today, and I also feel a bit sad about having to close that after all this inspiration we got from the best minds we could pick. Many thanks. My first message would be really to thank all of you for attending. I'm told that we've been about 150 in the room, but 950 connected remotely this afternoon, so which is quite an achievement. And I'd like to thank you for attending only, because that's probably the best gift you could make to the EBA. I mean, first by showing how important it's been, the work done over the past 10 years, and I'd like to share that with my colleagues tonight. I mean, they've been doing such a great job. It's been mentioned several times. And I think this pays a high tribute to what they've been trying to achieve over the past 10 years that you could attend, so many of you this afternoon. So many thanks from the deepest part of our hearts for attending this afternoon. I'd like also to thank the organizing team. They've been working hard over the past months to try and organize a hybrid event with all the uncertainties. That was led by Philip, Katerina, Franca, many others. I couldn't quote all of them, cite all of them. So many thanks to you for this great gathering, which seems to be reopening a bit our normal ways of working. And for many of you attending here today, they told me that this was one of their first meetings after a long time of connecting remotely. So really, that's also great. Thank you for joining us in presence or also remotely. Now, on the substance, we've heard a lot. So from an EBA perspective, it's been fantastic because we can prepare for the next decade now with everything we've heard this afternoon. We had so many insights. I picked a number of important lines and messages, and don't worry, I'm not going to repeat them tonight. But we heard a lot about green, about climate, of course, about digital, about also people, not forgetting about the human touch on this. And that cuts across the unfinished business as well as the new frontiers, as we like to call them at the EBA, meaning the transformation that's needed going forward for the banking sector, so that the banking sector and the banks keep to perform their functions, which is really to really serve the economy. We heard a lot about the innovation or efficiency, stability trade-off, and that's also something that cuts across the old topics and the new topics. And we'll be working hard on that going forward. We reorganized the authority on the 1st of June to try and prepare for those new frontiers. We've created precisely a unit dealing with digital finance, another one dealing with AML, and one dealing with ESG risks. We tried to bring together the topics related to digital finance and to personal finance and consumer protection together more and more, and we'll certainly be continuing in that direction. So many thanks for all this. I'd like to really say to all of you who attended remotely, see you soon, à bientôt. I mean, come and visit us in Paris. I hope we'll meet also maybe in different places, not in a too long time. And for those of you who can stay with us, let's regroup over a drink in the room just outside. Thank you very much, and a nice evening to all of you.
On the 1st of January 2021, the EBA turned 10 years old. The EBA was part of the European response to the great financial crisis of 2008, with the mission to set common standards for all EU banks, maintain financial stability in the EU, safeguard the integrity, efficiency and orderly functioning of the banking sector, and safeguard the consumers of financial services. It all started in 2011, when the EBA set the foundations of the Single Rulebook, a body of common rules for the EU financial sector that would complete the single market in financial services. The Single Rulebook relies heavily on the EBA, who is mainly responsible for developing binding technical standards, guidelines and recommendations. In 2011, in the midst of the sovereign crisis, the EBA introduced the EU-wide stress test exercise as a tool to identify weaker banks, quantify capital shortfalls and require competent authorities to adopt corrective measures. The EU-wide stress test has been instrumental in reducing uncertainty, enhancing transparency, and restoring trust in the EU banking sector. In 2012, as part of the European Council's comprehensive package to address the sovereign debt crisis and restore stability and confidence in the markets, the EBA proposed a recapitalisation plan aimed at increasing the robustness of individual banks through the build-up of capital buffers commensurate to sovereign exposures. With the introduction of a common definition of non-performing loans, NPLs, in the EU, the EBA laid the foundations for a sound and conservative assessment of asset quality across the EU countries. On the 23rd of June 2016, the United Kingdom voted to leave the EU. Since then, the EBA has been working to ensure the European banking system had contingency plans in place and that consumers were adequately informed of any possible risk and made aware of all the changes in cross-border payments between the EU and UK. It also had to organise its move to a new home in Paris. Since March 2020, the EBA has been providing support to mitigate the impact of the COVID-19 pandemic on the EU financial system, with a range of regulatory measures complementing and supporting other public support measures, such as payment moratoria. The EBA has been able to respond to all these challenges and to fulfil its tasks and mandates thanks to the commitment of its staff and the great cooperation with all its partners across the EU. The EBA is a key component of the EU single banking market, which has become more solid, transparent and beneficial for all. Thanks to the EBA, all financial institutions of the European Union are safer, have the same rules and follow harmonised standards, with great benefits for all citizens. The EBA is now projected into the future. It will continue to produce evidence-based regulation in traditional sectors, but also in new areas such as fintech, sustainable finance, and anti-money laundering, just to name a few. And this is only the beginning.